everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
If people expect inflation, then they're more willing to accept it.
The risk-free rate right now is manipulated by central bankers all over the world.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Kicking off the month of June from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up 17 on the S&P. We advanced 0.4%. What a month we've got coming up for you. The ECB coming up in about a week. The Fed after that. Before we get there, Tom Keene, Friday, payrolls.
Yeah, well, Friday payrolls will be very, very big, John, but I really center on the Fed meeting June 16th and the basic idea this morning that the markets are doing what the Fed wants. They're doing the heavy lifting for the Fed. George Saravelos with a very sharp note from Deutsche Bank in the last few hours, really talking, John, about it's just like a rate cut to see the dollar dynamics in the short rate market with the flood of money, the wall of money the Fed has given us.
And we've got some stability in the bond market too, Tom, we need to talk about. Right now, a 10-year 162. Your average since 10-year yields topped out at the end of March, 161, 162. I'd argue that's probably good news for them, isn't it, over the last couple of months?
Yeah, the stability there is great, but in the short, where the pros are in the short rate market, there's a lot to watch for. Overnight reserves, I don't know if I have a good reading on that yet, John. It hasn't really ballooned out to new highs over the long Memorial Day weekend, but it's just the wall of cash that's out there as we end the pandemic in America is really moving markets.
Are you calling the end of the pandemic, Tom? Are we done?
I'm not. No, let me be careful there.
In the United States, just to clear that up.
In the United States, I'm calling it, but I'll tell you, it's shocking in other nations that are behind on vaccination.
Lisa, 650,000. That is your estimate this Friday.
And transitory is really the key word, as Tom was talking about. And I'm wondering how much we're going to get any nuance to what could be transitory from Federal Reserve officials before their blackout period, given the fact that there is this wall of cash that's going to continue pushing asset prices higher, regardless of the fundamentals, whatever that means anymore, John.
Jim Bullard in the FT. Tom Keene, Jim Bullard sounding very, very hawkish at the St. Louis Fed. Lisa bringing up the Fed speakers. I think you've got to look out for that. He's not alone. That list of people is starting to build quite quickly.
Well, it sets up for a June that's going to be interesting. I mean, with the commodities busting out all over is one thing Mr. Bullard's looking at. But you're right, and there's going to be different nuances here. And, you know, I'm not a big fan of the parlor game of the Fed speak, but the idea here, John, of look at the markets as they try to price a global recovery from this natural disaster.
Well, let's look at the markets right now, Tom. Tuesday morning, good morning. Equity futures up 18 points on the S&P 500, 4220 through 4,200 on the S&P. We advanced another 0.4%. How many times have you said that, TK?
I said it to a huge
repeat. Going to hear it again and again and again. In the FX market, euro dollar unchanged, 122.28. Lisa, yields just sat the 162 on a 10-year this morning, just creeping higher by a couple of basis points.
Yes, the name of the game, though, as you said earlier, is stability. We continue to see that stability in bond markets, and I really am trying to understand what the marginal deciders could be for the Federal Reserve as to when to start talking about tapering and really talking about transitory, which may be a bigger deal. All right, here's what I'm looking at today. Starting at 9:45 a.m., we get a slew of manufacturing data. 10 a.m., we get U.S. April construction spending and May ISM manufacturing data, followed a half an hour later by the Dallas Fed manufacturing index. Key question in my mind, how much have input costs increased? In other words, the inflationary impulse into the producer, how much has that forced them to consider pricing and force prices higher for the end consumer? We have seen this again and again. How much does this crimp what they actually produce? These are questions that people are looking at to try to determine, decipher how long-lasting, how transitory this inflation really could be. 2 p.m., Lael Brainerd of the Federal Reserve, Fed governor, going to be speaking at the New York Economic Club. Again, the key question I have is, what are they looking at to determine when they should move away from this temporary blip? What are they going to potentially reconsider? And she could follow in the footsteps of Jim Bullard with respect to taking a little bit more of a hawkish tone. And then today, and this really is probably the key market story of the day, OPEC Plus is meeting to discuss July output, expecting to ratify output increases. We see prices on Brent, prices on WTI rising to the highest levels in about 2 years because people people are actually driving places and actually flying places, John. And this has led to something of more of a tightening in supply-demand dynamics. The key question really is Iran and what happens if the agreement comes to a pass and they're able to start shipping oil.
Lisa, that's the commodity market. Your take on foreign exchange. Dollar China 6.38. Your take on the latest move out of China.
This is a huge, huge deal. And basically, China, for a long time, allowed the yuan to strengthen versus the dollar. And then yesterday took a pretty big measure, starting to actually came out with a peg that was weaker than the expected reference mark for the yuan. And then today, for the first time since the financial crisis, required banks to hold higher reserves of foreign currencies, basically trying to weaken, to offset some of the rise in the yuan. I really wonder how far they will go, what triggered this, and what this means for a dynamic that a lot of people thought they would actually allow to continue to climb.
It's a 10% move in China's favor over the last 12 months. Tom, here's your headline. Nobody wants a stronger currency. This one's going to get a little bit more interesting if we have to see some dollar weakness in the months ahead.
The old line race to the bottom. I would note moments ago, euro-yen, which is a major pro pair, just went out to strong euro, weaker yen. And one of the overlays here, as we go to John, one of the overlays, John Ferro, is the stronger euro. It's irrefutable.
Well, let's go to John right now. John Stolfus, Oppenheimer Asset Management Chief Investment Strategist. John, let's start right here. Just a massive month ahead of us. The ECB, the Federal Reserve, payrolls this Friday. After the big downside surprise on payrolls last month, what are the lessons learned going into this Friday?
Well, I got to think that investors are going to have somewhat a trepidation as we get closer to that Friday date for the non-farm payroll number. I mean, they're looking for what, 650,000 K versus 266K, which is what we got the last time. And ahead of that, as I recall, there were some predictions that it was going to come in at 2 million. So we'll just have to see how it goes. Our understanding of the markets from the period that we've been in the markets, the last 38 years, is this is not uncharacteristic, the uncertainties that we're dealing with when you're coming out of a major crisis. And you just have to right-size your expectations.
John Stolfus, I want to congratulate you on being a persistent and courageous bull in the heat of the pandemic. You were right. What is the thing you're studying or the thing that would trigger you to a more cautious outlook?
Tom, it would really be an indication that the Federal Reserve was indeed asleep at the wheel, that it had become locked into this idea of just leaving the faucets running irregardless of inflation ticking up, should it become no longer a transitioning or transitory kind of occurrence. That's what would worry us. We look at the economic data on a daily basis, and so far so good. It's not great, but it's not poor. Progress being made, and the inflation that is occurring is still linked to some of the disruptions in the supply chain in a wide variety of areas, from food to technology.
Well, that's the economy, and the economy and the stock market are not necessarily on the same trajectory. There are signs of cooling in certain pockets of the froth, whether it's the SPAC market, whether it's the IPO market, where you're not seeing the same kind of pop as you used to, whether it's the junk bond market, a feeling that things are actually hitting their peak. Do you think that this is a blip, a pause in an incredible rally, or do you see this as a sign of what's to come for the rest of the year?
Lisa, our particular focus is really on the core of equities. So, what we're looking at is a combination of growthier value and garpier growth. Stocks that are doing quite well, actually, in this period. We think when it comes to the SPACs, when it comes to the IPOs, that's where you saw the froth. And they are essentially, they're not the center of the circus, so to speak. They are other rings on the outside, or what you might call the side rooms in Las Vegas, the lounge acts.
Too many fancy terms, John. Way too many fancy terms. Can we keep this simple? Are we sticking with the banks, the big banks on Wall Street?
Yep, we want to stick with the banks. We want to stick with the industrials, and our contrarian picks for the third and fourth quarter. We think you want to be now accumulating big tech, and you also want to be accumulating consumer discretionary, which is likely to benefit from a successful reopening of the U.S. economy.
John Stolfus, we've got to leave it there. Fantastic work, as always, sir. Oppenheimer Asset Management Chief Investment Strategist on the equity market and the path forward after delivering another tidy month of gains for the month of May for the S&P 500 banks. Here's the quote from Jim Bullard, the St. Louis Fed president, speaking to the Financial Times in an interview this morning, guys. I'm evolving towards a judgment where labour markets should be interpreted as fairly tight. He goes on to say, quote, even though it's a booming economy and GDP is growing leaps and bounds, I'm not sure employment is going to follow. Tom, you sent me that interview this morning. What's your take on that?
My take is there's three Americas out there, and Dr. Bullard is exceptionally prescient on this, his work out of Indiana over the years and the research heritage of St. Louis. There's a fully employed America, John, across all the different deciles. There's another part of America coming back from the pandemic, so it'll be like February last before the pandemic. And then there's a part of America that's undertrained. Jeff Sachs has been brilliant on this at Columbia. There's a whole piece of America that just is not in the game. Dr. Bullard's adjusting our labor dynamics for that group that's not in the game.
Lisa, President Bullard adding that he did not expect monthly job gains as high as 1 million in the coming period.
I wonder what the pressure is, though, on him that's causing him to take a different tack. Is it worries about financial stability? And this, to me, is a key question, as Tom was talking about all that cash sloshing around. It's got to go somewhere. So if we don't see the inflation in the core economy, if we don't see more employment, you get asset price inflation, and that's got to be scary to certain federal officials, Federal Reserve officials.
Yeah.
And you wonder how much that's what's underpinning some of his concerns.
I'll avoid taking a guess on what he's thinking, and I'll just take a look at what he's actually saying. He's worried about persistently above target inflation, I think, Lisa, going into next year. Pretty much what he says in this interview. And if the labour market is tighter than they all think, then that really, really raises the prospect of being behind the curve in the years to come.
But it also means that he doesn't have faith that the Fed has the tools to address that inflation in a calm way with respect to the markets in that circumstance, which is actually counter to what a lot of people, including Janet Yellen, have been saying.
How lonely do you think he is on the FOMC right now? Pretty lonely?
I think less lonely than he was 6 months ago.
John, we slotted in the pendulum of stability here at 6:12.
I think that sounded a little bit more doomy than stability, to be honest with you.
Come
Don't
on.
you think?
We're in search.
He's had a long weekend, Tom.
To really just pump up the
Took
gloom.
the extra day off.
All I was told, I
Missed
got to
all
watch
this.
Kate Winslet. I have been told by 42 family members,
Kate
stop
Winslet.
everything and watch Kate Winslet on HBO, and I'm
It's
trying to get
fantastic.
there.
Yeah.
She goes, Jack,
Mayor
Jack.
of Easton.
I think that's
Oh,
a
I thought
different
it was
movie,
Titanic.
Tom. 7 a.m. Eastern
What are we
time.
talking about?
Ed Yardeni Research President. He's thinking of Titanic.
Oh, sorry.
You know that
I know,
moment, Lisa?
but that's
what he's
not what's on
talking about.
HBO.
I know. Tom's just distracted. I have no doubt Tom's going to watch Kate Winslet whilst this program is on.
Got that right.
1,000%.
From New York. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. China has taken its most substantial move yet to rein in the surging yuan. Beijing is forcing banks to hold more foreign currencies in reserve for the first time in more than a decade. That effectively reduces the supply of dollars and other currencies on shore, and that puts pressure on the yuan to weaken. President Biden will unveil plans aimed at reducing the black-white wealth gap. That will happen today in Tulsa, where the president will mark the 100th anniversary of a massacre that took place in a prosperous black neighborhood. President Biden is expected to offer proposals aimed at boosting home ownership and helping minority small businesses. In tennis, women's star Naomi Osaka has dropped out of the French Open because of a dispute over mandatory press conferences. Osaka said in a social media post that she has suffered from depression and social anxiety disorder. She says that taking part in press conferences makes matters worse. Osaka is ranked second in the world. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
But the president keeps saying inaction is not an option, and time is not unlimited here. The American people expect us to do something. They expect us to deliver, and it's my hope that these continued conversations, really over these next few days, will be productive and will lead to that clear direction.
Secretary Buttigieg there doing the rounds at a Sunday talk show stateside over the weekend from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Tuesday morning, price action set up as follows. Equity futures up 19, advancing 0.4 in a bond market, yields just south of 162 at 161.98 on a session up by a couple of basis points. And kicking off the month of June in the FX market, euro dollar in and around 122, 122.28, and totally unchanged on a session. Brief mention of crude, a tighter commodity market, a tighter oil market later this year. OPEC Plus looking for some of that, $68.12 on WTI, up by about 2.7% on the session, Tom. Crude advancing this morning.
Yeah, really nuanced today. For June 1, as we start the summer, there's a lot going on in the markets. Again, John Stolfus there on the equity lift and his optimism as well. Right now, to stagger through the weekend and to survive into a 4-day work week in all of June, Martin Schenker joins us, Bloomberg editor-in-large in charge of voting rights here at Bloomberg. It is sort of an arcane topic, but there it is. And over the weekend, the Texas Democrats waltzed out of the legislature. The Republicans were stymied. I guess they'll get something through. It's a battle brewing to 2022. How does Washington affect states' decisions on voting rights?
Well, obviously, the issue of who is eligible to vote is a states' rights issue. If Washington wants to inject itself into the debate, it's going to be rancorous, to say the least, if the Washington establishment tries to enforce voting rights on the states.
Does Greg Storr just understand this will end up in the courts?
It will probably end up in the courts, indeed.
Yeah.
And then it'll just be a basic states' rights issue. Who decides who gets to vote in national elections? Is it the states or is it the federal government?
Marty, as we talk about voting rights, as we talk about what's going on in Washington, D.C., we also continue talking about what happened in China. And I do wonder what the international implications are of President Biden kind of doubling down a little bit on investigating the theory that this could have initiated from the Wuhan lab that I'm talking about, the COVID-19 crisis.
Yeah, it's an extraordinarily sensitive issue for the Chinese. And, even though there is no specific evidence, the fact that Joe Biden sent this issue back to his national security team for analysis has got to be really concerning to the Chinese. And, Joe Biden has basically taken an approach that his predecessor has taken, which is ironic, to say the least.
Well, people are saying that this is actually potentially dangerous because China has tried to avoid this theory for a long time. What is the big international potential consequence here? Because it's not just the U.S. Australia also raising questions here. Tensions rising between China and a number of other allies of the U.S. in addition to the United States.
Well, if it is ever proven that the Chinese somehow hid the fact that this escaped from a lab, the international consequences would be severe. My own feeling is that it's probably never going to be proven. Someone out there probably knows the answer, but if we ever hear it, I'll be surprised.
Does anything get done in Washington in June? It's the oddest month. It's like it's not 100 degrees yet, and now we all have air conditioning and all that. But the heritage of the city, am I right? Nothing gets done?
It's very little gets done, and I think the framers of the Constitution sort of decided to place the Capitol in Washington so that it's so warm there, Congress doesn't meet, so they don't do anything in the summer months.
In all your experience, I mean, it's basically 1920 or 1820 for that matter, isn't it?
It is. But, I will say that it looks like this whole infrastructure issue is going to come to a head pretty soon.
You think it's going to come to an it's interesting.
Yeah.
Well, and that's actually exactly where I wanted to go, this idea that people are already pricing in some sort of infrastructure spending plan. What's the contour of this particular plan, given the bipartisan effort that's taking shape?
Well, I think this meeting with Senator Caputo and Joe Biden this Wednesday is going to be critical. The issue, obviously, Jonathan has talked about this all the time. They can't even define what infrastructure is. If they're able to come together with a definition that works for both sides, then the big issue is how to pay for it. And that's where there is a deep fundamental philosophical divide.
What's the latest headline number that you keep getting from sources?
I keep getting somewhere south of $1 trillion, if they can agree on a number like that and agree to how to pay for it, then I think you're going to get a deal.
Marty, got to leave it there. Congress getting back to work in the next week. Marty Schenker there, Bloomberg editor at large. Some breaking news for you. A share sale from Amc Entertainment. 8.5 million shares for $230.5 million. Looking to use the proceeds from this, Lisa, to maybe purchase some theatre assets and leases, and maybe looking at deleveraging opportunities as well.
Yeah, that's a key issue, as you were talking about before, that they need to reduce some of this debt to give themselves more flexibility going forward. My question is, what is their business model going forward? Is it just going to be movie theaters? And if so, does that look the same post-pandemic as it did pre-pandemic? I mean, do people want to go back to sit in movie theaters?
No idea, but one thing they're looking to do in the near term is take advantage of a massive equity cushion and a big rally that's been taking place. Tom Keene in the pre-market, AMC up by 6 percentage points, up by 6.32%.
It's a bull market, and odd things happen. I can remember a few years ago where you were attracted to prime brokers if they could offer you Krispy Kreme to short. And then Krispy Kreme was put out of its misery, and now we have Krispy Kreme thinking IPO.
They've filed publicly for an IPO. I don't think they're thinking about it, Tom. I think it's happening.
All things Krispy Kreme come full.
You don't sound bullish about this, I've got to be honest with you.
No, actually, I sound hungry about this.
Yeah, Tom's way of breaking news is really gold.
Dunkin' Donuts to come out with headlines.
Well,
right
TK,
now,
I think your word choice was interesting there. The phrase you used, bull market. You weren't talking about bubbles. You were talking about a bull market. Just a consequence of a bull market.
You know, I'm removed from it. I'm in triple leveraged all cash, and I'm happy. I mean,
are you happy?
My downside
still
risk
looking
is
for an
high.
entry
He
point.
sounds miserable this morning, I've got to say. AMC, part of the story this morning, then up 6% in the pre-market. Krispy Kreme filing publicly for an IPO. And when you look at the weightings, just quickly, TK, the weightings of the Russell right now, the number 3 weighting on the Russell, GameStop. The number 8 weighting on a Russell right now, Lisa, AMC Entertainment.
Yeah, and the idea here that AMC Entertainment also has been a meme stock, right? So how much are people going to end up benefiting from this? But you do think about some of these key players being such big weightings of these indexes, what that does.
I'm not ignoring you, Tom. Just the punchline should come at the end.
John,
just inching towards the end of the segment to give it a punchline.
John,
go ahead, please.
There was so much rain this weekend, Kennel Fee started quacking like a duck.
Okay, is that really what you wanted to say?
Yeah, that's really what I wanted to say.
If I'd let you say that 60 seconds ago, do you think that would have helped the flow of the program?
It would have helped, smarten up the program here.
Okay.
You didn't think I was going to have a punchline?
No, Lisa, I thought you'd add some value, which you did. Coming up.
Sterling, the
Bob
Prime
Hormats,
Minister got married.
Tiedemann Advisors Managing Director. You and I weren't invited, Tom.
How's Mayor of Easttown, Tom?
42.21 on the S&P. Lisa, you know he's watching that.
I know.
Up 0.4% on the S&P. Equity's doing okay to kick off the month of June. This is Bloomberg. .6:30 in New York this morning. Good morning. Kicking off the month of June, your equity market looks like this on the S&P, advancing 0.4%. On the Nasdaq, up 0.4%. On a Russell, up 0.6%. After a slim month of gains for the month of May on the S&P 500, the banks, and that rally continued, up by more than 5% on the S&P 500 bank sector through last month. If we switch up the board and get to the bond market, payrolls coming up on Friday, 650,000 is your median estimate. Yields going into that higher by a couple of basis points on a 10-year to 161.98, up by 2 or 3 basis points on the day. Over the last couple of months, though, we've talked about this continuously. The amount of stability you've seen in the nominal yield since we topped out at 174 on a closing basis at the end of March has been pretty phenomenal, hasn't it? When you think about it, your average has been about 161, 162, and that is where we are again this morning. Let's finish on this. The news that the OPEC Plus team are looking for a tighter oil market in the second half of this year, and a rally going into an OPEC Plus meeting a little bit later, up by 2.65% on crude. WTI with a 68 handle, Brent with a 70 handle. Your year-end estimate still 63, 64 on WTI and about 68 on Brent. South of that, of where we are right now, Tom? Brent 70, WTI 68. When you're looking at the forecast, some people still doubting this can continue.
You know, it's going to have to see. And, frankly, it's a more active market than I expected on a post-Memorial Day Tuesday morning, John. And there's a real correlated lift here, again, with that commodity lift dovetailing right into an equity lift. We start strong this 1st of June, and we do so with the right guy at the right time, because we didn't know over the weekend that China would profoundly change a birth policy from 1 child to 2 child to 3 children. 3 bouncing babies. Robert Hormats joins us with Tiedemann Advisors and their managing director. And what is so important here, Bob, is the arc of your service to the nation goes back to Nixon and truly the opening of China in the 70s. Explain the baby policy long ago and far away.
Well, it's a very interesting change because, as you correctly point out, Tom, traditionally they've had a 1-child policy to avoid a very large continued increase in population. Now their population is turning downwards. They want to keep an active, vigorous workforce, so they're now permitting people to have 3 babies. And a lot of Chinese families would like to do that. That's part of their tradition of having large families, one of whom takes care of the parents, stays in the village. So it's not, this is culturally sort of going back to China, maybe 50 years
that's
ago.
Right where I wanted to go, Bob. This is really important. You mentioned the culture of China. Is America, in its bipartisan policy to China, blind on the culture of China?
Well, I think we need to understand it better. A senior Chinese once told me, your understanding of history in the United States, the way it's taught, really starts at Athens and moves west. It's Athens, Rome, and all the things that go on in Europe. Whereas a whole portion of the world, the Middle East and East Asia, had their own cultures and their own histories. And China's is 5,000 years old. And we have to understand that that culture is not going to change, and they've changed their government since the revolution in 1949. But the culture of China is a very deep one, and one of the things we have to remember is education is a critical part of that. It has been for centuries and centuries, and it will continue to be. And we're dealing with a country that is very formidable in its emphasis on education, and now and particularly in technology education.
Bob, do you think that their perspective on history is what led us to believe that we could get them to become more like us? The Western governments could get China to actually adapt the system that has driven the growth of the last 50 years?
That is right. And I got to know Deng Xiaoping quite well during the period that he was in power. And he said, we can learn. One of the major things I've done is to open China up. The universities were closed for several years during the Cultural Revolution, and Chinese were not permitted to study, many Chinese were not permitted to study abroad, including the United States. He said, now we'll be able to open the universities in America, and Chinese will be able to study in America. But he said, one thing to remember, we will learn from you technology and a whole lot of things. You have a lot to teach us, but it doesn't mean we're going to change our system. And he said, you have to make the distinction between learning from you and that causing us to change the fundamental system of China, which has been based on 5,000 years of culture. So we have to understand, a lot of Americans were naively of the view that once they became a more market-oriented economy, which they have, they're also going to move toward a democracy. And that the Chinese, even early on, said that we have our own way of doing things, and because we move in one direction economically doesn't mean we'll move in a democratic direction.
Bob, that word you used, though, naive. When you look at the approach from this administration, do you sense continued naivety?
No, I think the people in this administration, Jake Sullivan, Tony Blinken, Kurt Campbell, have a very good understanding of China. They've worked with China. I've worked with them very closely. Jake and I went to China several times with Hillary Clinton when we were in the State Department together. Tony Blinken has been there with Biden when he was working for Biden. Kurt Campbell knows China as well as anyone. These people are not naive. They're very knowledgeable about China, and I think the Chinese respect the fact that they understand China quite well.
So then distinguish what their approach is to President Trump's. In other words, what they want to accomplish with their Chinese-U.S. policy that perhaps Trump did not.
Well, I think the tone has changed quite a bit. And I think they want to do two things. One, they do want to have a good dialogue with the Chinese. I mean, they've said that. I mean, the first meeting didn't get off to such a great start, but it was certainly a meeting. The second thing they want to do is work with their allies to a greater degree. And they have a view that they will be more effective in influencing China on certain issues, not all issues, but certain issues with the Quad and with other allies. The Trump administration picked fights with all of our allies, and the Chinese said, well, how are the Americans going to do anything vis-a-vis us if they can't even really get along with their allies and they don't have a unified view among their allies on what they want?
Bob, if they want a better relationship with China, how does this investigation into the origins of COVID-19 fit into that? This idea that President Biden is doubling down on the theory that originated from the Wuhan lab, and people are basically saying that, which could potentially really throw a kink in the relationship between the two nations, even though there aren't necessarily significant health consequences in the near term that would stem from that.
Well, the answer is I don't know. I don't know what they know and what they don't know and what their objectives are in this. So I really can't comment on that. I will look beyond that, though, and say that over a period of time, there is, in the health area and the climate area and many others, these are the two most powerful countries in the world with also a substantial amount of scientific expertise. And over a period of time, we're going to have to work with the Chinese and get through this period to deal with the pandemics of the future and deal with flu. We get a lot of information, early stage information on Asian flus from the Chinese, which helps us to develop our vaccines here because the flu tends to move from Asia to the U.S. So whatever happens now, whatever the reasons behind it, and I just don't know what they are, over the medium term, we're going to have to work with the Chinese on health issues and numerous other issues, climate issues, financial issues. Don't forget, we were able to deal with the 2008 financial crisis in part by working very closely with the Chinese. So we have to sort of divide these things into short and medium term elements.
Bob, where does trade come into this? Because there's been a real tensioning in the relationship there with tariffs and certain agreements that China came to that they have not necessarily fulfilled when it comes to buying U.S. goods. What does the Biden administration want to see with trade between the U.S. and China?
I think what there are certainly as you recall, there were a few issues in what was called phase one. Mostly China buying more stuff from the United States, agricultural products, natural gas, things of that nature. Now we're going to have to move to phase two, which is agreement on intellectual property, trade secrets, a whole range of things. And we have a very competent trade negotiator. And I think there's an understanding that at some point we have to move not to some grand new phase two deal, but identify 2 or 3 or 4 areas where we need to reach some level, if not total convergence, at least a framework for dealing with these issues. What we're doing now is we're sort of moving apart. We're becoming more self-sufficient. China's becoming more self-sufficient in certain areas like that have to deal with very highly advanced 21st century technologies. But over a period of time, we need some degree of understanding of rules to deal, the framework for dealing with some of these newer technologies, safety issues, for instance, ethical issues, a whole range of things when we deal with things like AI or quantum computing. And someone has to set international standards for these things.
Yeah.
And the two most important countries are China and the U.S. If you look at the legislation that's being produced now, a part of it is to have the U.S. be a leader in setting international standards. China wants to be. We should also be a leader, and we have to work with them on international standards for the newer technologies.
Ambassador.
Otherwise, we'll have a fragmentation of the world, and each country will have its own national standards, and that's not healthy, and it doesn't improve efficiency.
We're against the clock, but you know I love catching up with you. Bob Hormats, Tiedemann Advisors Managing Director from New York City this morning. Good morning. Equity futures up 0.4% on the S&P through 4,200 alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro, up 18 on the S&P. We are positive 0.4%. Your yield higher by a couple of basis points to 161.81. For our audience worldwide, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. U.S. oil futures climbed to their highest in more than 2.5 years today. West Texas Intermediate rose as much as 3%. OPEC and its allies are forecasting that the global market will tighten up. The cartel says the oil glut built up during the pandemic has almost gone. France's President Emmanuel Macron demands to know if the U.S. is still spying on EU leaders. Macron was reacting to reports that American intelligence monitored Germany's Chancellor Angela Merkel and other European politicians with the help of Denmark. The Danish are amongst the U.S.'s closest allies in Europe. And there's a report that Japan will allow some spectators at next month's Summer Olympics. According to TV Asahi, organizers will let domestic fans attend the games. Spectators will be required to have a negative virus test or a vaccination certificate. Fans from overseas would not be allowed to see the Olympics in person. And the world's biggest meat supplier has become the latest casualty of a cybersecurity attack. JBS says it shut its North American and Australian computer networks after an organized assault on some of its servers. The JBS attack took place 3 weeks after the operator of the biggest U.S. gasoline pipeline was targeted. Instacart has a plan to replace its army of gig shoppers with robots. It's part of a long-term strategy to cut costs and put its relationship with supermarket chains on a sustainable footing. Bloomberg's reviewed documents that detail the plan. It involves building automated fulfillment centers around the U.S. where hundreds of robots would fetch boxes of cereal and cans of soup. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's vaccination, vaccination, vaccination. That is to find how robust the recovery is. We need a very important effort to be able to get vaccines into the arms of people in developing and emerging economies. And without that, we won't be able to say that we've overcome the crisis.
Angam Gurria there, the OECD Secretary General from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Counting it down to the opening bell stateside in New York. Equities up 18 points on the S&P 500. We advance 0.4% after a slim month of gains for the month of May on the S&P 500. Coming into June, your yield is higher by 2 basis points. A little bit more than that this morning at 161.81 on 10s. FX market, euro dollar unchanged at 122.25, and crude a 68 handle now on WTI, up 2.5%, Tom, to $68 and about 1 cent.
A little misleading. On the way up, I look at Brent. On the way down, I look at West Texas Intermediate. On the way up here, $70.64 on Brent crude, more of the global price. You've got lots going on in commodities. We'll discuss that here in a moment. Right now, let us wander out to 2025 or maybe out to 2030. We do that with Amish Adalja of Johns Hopkins Center for Health Security. And what is so important here is people like Dr. Adalja wander out into the rural parts of China looking at bat research and how it links into people research and what it means for the future of COVID. Dr. Adalja, out 4 years, out 5 years, do you just assume there will be more COVIDs?
You definitely have to assume that there's going to be more COVIDs. We know that the coronavirus family has many different viruses that are circulating in bats, some of which are going to have the capacity to infect humans. So we have to be prepared for the next COVID. We have to understand how this coronavirus found its way from bats into humans in order to make us more resilient to the next coronavirus emergency. And there are whole other viral families as well that we have to continue to be vigilant about. There will be another pandemic. There will be more infectious disease emergencies. We have to be ready, and we can't have the same mistakes occur again.
Is that the warfare of university against university in terms of funding it? Or do you look to larger government and NGO institutions to drive forward the research?
It's really all of the above. You have to remember that infectious disease, when it gets to the point of a pandemic, that really becomes a national security emergency. And it is incumbent upon governments to think about public health infrastructure as part of national security infrastructure and fund it that way. So right now we have a chance to get this right with the U.S. government in terms of pandemic funding, in terms of prioritization, as well as globally with NGOs that are engaged, as well as universities thinking of new research that they're getting involved in. And it even goes down to the local and state level. We have to improve public health infrastructure at that lowest level if we're going to be resilient, because that's where a lot of the failures happened, was the fact that local health departments didn't have the ability to test, they didn't have the ability to contact trace, and that really put the United States in a bad position. Now everybody sees what people have been talking about for decade after decade, the neglect of public health.
I'm really kind of shocked that Tom didn't start with Greek, the idea that alpha, beta, gamma, delta, alpha being the variant that we saw coming out of the United Kingdom, and delta is the variant coming out of India. The new names, because the old names were too confusing, B1117 or B167. The question is, going forward, are we going to get a beta? Are we going to get a gamma that's going to potentially be more virulent, that's going to puncture through some of the vaccination protections and lead to another cycle in the COVID pandemic? Dr. Adalja?
I think we might have lost him, Lisa. Dr. Amc Entertainment there, Johns Hopkins Center for Health Security Senior Scholar. Well, you just put him to sleep, Lisa.
Speaking Greek.
Asking him about the Greeks.
Well, this is actually really interesting. They've actually come up with names for variants at this point. These sort of giving them Greek letters to sort of designate them, because they are expecting further iterations.
You're dead on, Lisa. And what I find, John, so important here.
I agree with Lisa for the record. I just found that pretty funny.
No, I'm not.
It was funny.
You know, I'm not an expert on this, but John, I get more questions from people about the effect of these variants than any other thing that we do. Let me rephrase Dr. Adalja, Lisa's important question, is the variants are front and center. What should we actually study from alpha to delta on the variants?
Well, I think that it's confusing now because we've got three different names. We've got UK variant 117 alpha. That's hard to remember, but I think people are going to use all the names. I do think what's important about the variants is to try and understand, are they more transmissible? What mutations make them more transmissible? Do they have the ability to evade immunity that you might have from natural infection? Meaning, can you get reinfected with the variant? And then lastly, are they able to evade vaccines? And what we've seen so far is none of the variants have the ability to evade vaccines, especially when it comes to what matters, preventing serious disease, hospitalization, and death. So it's important to track the variants and to keep a database of all of them. But I think that the solution to the variant remains all of our vaccines that are out there, Moderna, Pfizer, Johnson & Johnson, all work tremendously well when it comes to what matters with the variant. So that's the way that we get out of the variant problem, is to get more and more of the world's population vaccinated.
Dr. Adalja, in the meantime, this weekend, it seemed almost normal. People were walking around without masks. People were interacting, going inside. Is this appropriate? Is this the new normal, where we actually go back to the old normal?
I do think we are at that point now in the United States where the trajectory of the pandemic is such that we will be back to normal probably well before 4th of July. I think Memorial Day was a good marker. We've got over 40% of the U.S. population fully vaccinated, and that's kind of that inflection point that we saw in Israel when cases fell. And we've clearly tamed the virus, basically removed its ability to threaten hospitals, and that's the most important thing. So I think people are understandably and justifiably feeling that this is getting back to normal. We're still going to have cases. We're not going to get to COVID zero. We still want more people to be vaccinated. We want that number to be as high as possible. But I think we are on the way back to normal imminently.
Doctor, we've got to leave it there. Thank you, sir. Dr. Amc Entertainment there of Johns Hopkins, the Center for Health Security, Senior Scholar. Going back to normal, Lisa, I wonder if we've forgotten how to socialise. Have you seen some of these videos coming from the likes of Southwest? The rowdiness I mean, it's unbelievable.
Well, I've actually seen that people are struggling with small talk, but more than that, people don't have patience for it.
They're hitting flight attendants, Lisa, never mind struggling with small talk.
Hold on a second. Hitting flight attendants is just people being
They're going to ban
wrong.
alcohol now in coach. I think Southwest and American Airlines following. Tom, the good news for you, sir, I think they continue to serve alcohol in business. In a business cabin, you're going to be okay.
Yeah, well, I don't know what to make of this, really. I mean, we've never been here, John.
People have been pushed to stay home for 12 months and they're exploding.
That's not why they're punching. That's not why they're
I think people have
punching
forgotten
anybody.
how to socialise, Lisa. They've forgotten how to interact with people.
There is an element also of desperation. I mean, the idea of 14 months of not being able to engage with the world in ways that were familiar, I think, led to substance abuse, led to depression. You see that spiking all over. You wonder if that's going to percolate out. We've seen increased crime in a number of different cities. How much is that going to continue, and how much will that come down as people relearn social norms?
Interesting to see what's happening in Florida. Governor Ron DeSantis basically threatening to fine anybody, any company that asks people to prove whether they've been vaccinated. The Washington Post this morning in an article, one Florida concert promoter thinks he has a workaround. Offer $18 tickets to anyone who's vaccinated and charge $999.99 for everyone else. Still trying to work this out in this country. Coming up next, Ed Yardeni Research President from New York City this morning. Good morning. Tom Keene.
Yeah, we're trying.
Lisa Abramowicz.
We're trying to do it as well
Jonathan
as the British.
Ferro.
We're just trying to keep
Equities
up with
up
the
19.
excellence. The British.
This is Bloomberg.
That's a Swiss watch pandemic.
Everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
If people expect inflation, then they're more willing to accept it.
The risk-free rate right now is manipulated by central bankers all over the world.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The final month of Q2 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Tuesday morning up 19 on the S&P 500, advancing 0.4%. What a couple of weeks we got coming up for you. Payrolls on Friday, the ECB next week, and the Federal Reserve decides the week after that.
Yeah, John, there's no question about it. To get out to June 16th and the Fed will be a really key part of the month. But what's fascinating for me is it starts right now, right today, with the markets. We'll get to the markets in a moment, John, but commodities and equities speak volumes.
Crude higher, Tom, rallying, looking for a tighter market later on this year. That's OPEC+. Do you think they have to respond to that in today's meeting? In the meetings we expect them to have over the next several months as well?
They got to be enjoying it. They need it. I mean, all sorts of countries within OPEC are loving $71 Brent crude as well. I don't really look too much at it other than demand's a lot hard to gauge than supply. We spend more of our time on countable supply analysis rather than the emotion of demand. And, John, what this comes down to is GDP 10%, and we're going to fall off a cliff, and we're all going to slow down in late 2021, 6 months away. You know what? That's drifted away, that conversation.
TK nailed it. We spend way too much time talking about demand and not enough time talking about supply. That's true of the commodity market, Lisa. True of the labour market as well going into Friday.
And there's a question here of how much of the disappointment that we saw in the previous jobs report really stemmed from people not going back into the workforce voluntarily, basically these frictions that we continue to see. I'm really curious to see how much those frictions ease, how long lasting that will be, because that will determine one of the key factors in longer lasting inflation, which is wage growth. And that a lot of people are looking at as their primary director.
What is actually causing the demand-supply mismatch at the moment? It depends who you ask. If you ask the businesses, they'll tell you, the majority of them, Lisa, will tell you it's the additional unemployment insurance. If you ask the people, the potential employees, they'll signal it's everything but.
Well, part of it is childcare, right? The idea that people are not back in school, that children are not back to their normal schedules. How much is that? How much are the jobs that people are not going back to less desirable because they're dealing with big crowds of people and they are still concerned about doing so because the pandemic has not yet gone away fully? John, these issues are going to be parsed out for a long time.
Tom, do you think Friday's a political report or an economic one?
Both, always is. Frankly, it always is. But, John, after what occurred 29 days ago, I'm still not over just the, and granted, there's a pandemic, and I think we've all rationalized how we went from 1 million on down in jobs. I don't have a clue what we're going to see Friday. I have no wisdom on it whatsoever.
266, a monster downside surprise when we were looking for 1 million. Tuesday morning. Equities up 19 on the S&P 500. We advanced by about 0.5% on the S&P 500. Just a nice little lift on the S&P. The Nasdaq up a third. The Russell doing okay as well. In the bond market, yields are higher by a couple of basis points to 161.81. And euro dollar unchanged here, Lisa, 122.21.
All right, we're going to get a slew of economic data today having to do with manufacturing. 10 a.m., the key number is U.S. May ISM manufacturing data coming out. I am curious about supply chains. I am curious about the input costs of the raw materials. We'll also be getting some data on the housing market, which has been red hot. The spending on new construction, how much is that being also hampered because of the increases that we've seen in some of the costs of things like lumber and also like labor. 2 p.m., the Fed's Lael Brainerd is going to be speaking at the New York Economic Club. Very interesting to see how much she starts shifting her view. Does she start reiterating Jim Bullard's points that he made in the Financial Times, as you, John and Tom, were talking about earlier today? How much will she start to say that there are specific metrics, there are specific time frames that they're looking at to determine if this is a transitory surge in inflation that we are seeing? And today, OPEC Plus is meeting to discuss output for the month of July. They are expected to reiterate that they will see output increases. But the reason why oil is surging today is because they did say that they do see a tightening in the market heading into year end because of how quickly some of the reserves have been drawn down. Any details on that could possibly be the most interesting aspect coming out of these meetings, John.
All this demand coming back online at the same time. Lisa, thank you. Front page of Barron's over the weekend, the everything shortage. Tom, the everything shortage, from chips to autos to your favourite table at 8 p.m. on a Saturday evening to people in the Labour Report every single Friday. That seems to be the story of the moment.
The story of the moment is what we observed this weekend. I observed the Sikorsky was down because of the rain this weekend, John. I had to take a lift in, and it was $9 more than it's ever been. That's the reality people face right now.
Ed Yardeni joining us now, Yardeni Research President. Ed, love to do this with you. You coined the term bond vigilante decades ago, and many people have been asking the question, where are the bond vigilantes? With the yield still at 160 on 10s, where are they, Ed?
Well, I think they're actually back. You recall back in August, the bond yield was 0.52% as an all-time record low. And now we're somewhere around 1.6%. So, and much of that backup in bond yields occurred late last year and early this year. And then they went on a siesta. It's been really surprising to me that the bond yield has kind of gone nowhere fast over the past couple of months. But then again, I keep looking at the Fed data, and the Fed keeps buying notes and bonds. So I think that's the answer, is the Fed has been doing its best to keep the bond yield from going up. But I do think they're coming back. I think the siesta's over. I think we're going to see some bad inflation numbers up ahead here, just a continuation of the recent bad trend.
Ed, you own the high ground on this. We are honored to have you here on a June 1st. It comes down to George Akerlof writing late in the 60s, Mrs. Akerlof, presently the Secretary of Treasury, picking it up in the middle 80s, Olivier Blanchard with a definitive article on the wage price spiral. Weigh in here. Is that what's coming for 2022?
Well, I think anecdotally, there's just so much out there suggesting that the labor market's tight. And, what matters for wages is the extent to which employers view it as a chronic problem. And I think it is a chronic problem. You folks mentioned all the possibilities of why the labor market's tight right now. But I think the most important one is demographics. We forgot to have kids along the way here. And there isn't just too many people.
Yes, we did, John.
Speak for yourself. Ed, there is a question, though, here going forward that there has been these frictions. Yes, it's one thing that we haven't had enough kids generally, collectively, and our fertility rate collectively has gone down. On the other hand, there is this idea that we had all these people in the labor market a year ago and now we don't, right? And that is something distinct. What is blocking them from coming back online? What's your answer to this mystery?
Well, I've been looking at the labor force data, and it definitely shows that seniors are retiring. A lot of baby boomers who worked past 65, and some of them are now in their 70s. And they've just decided, you know what, it's time to just retire, meaning of life and all that. And then I think you made a very good point on childcare. We do have a childcare problem in the United States. We've had it for a long time. It was exacerbated by the pandemic. And I think as schools open up, as childcare facilities opened up, we are going to find people going back into the labor market. But nevertheless, there really is a shortage of workers, particularly skilled workers. And as you know, we've got almost as many, we've got more, almost as many job openings as we have unemployed people.
Let's build on that. I want to jump in. Just forgive me, Tom.
Please
come in with this. It came from Jim Bullard, the St. Louis Fed president in the FT. And he was talking about maybe looking at a different metric. And maybe this is exactly where you wanted to go, Tom. Bullard is starting to advocate for the Fed to look at other measures of job market tightness, the unemployment to job opening ratio. Ed Jardini, is that useful?
I think it's very useful, but it right now is indicating a lot of frictional unemployment, either a mismatch in skills or a geographic mismatch. Whatever it is, there's plenty of jobs out there. Employers are just, I mean, anecdotally, we see help wanted ads everywhere. But look, I think the good news here is employers, if they can, are going to use technology to increase productivity, and that should be an important offset in the next few years.
Ed, what is the level of inflation, just regular CPI, where you begin to see whispers of a time of a younger Jardini? What's the jump point where we get out to a new inflation?
Well, I keep writing about the roaring 2020s as a possible scenario here where productivity would be a tremendous offset to labor costs. On the other hand, I also write about the 1970s, and that's when I was a bit younger. And I am concerned about that scenario. We're starting to see a lot of similarities. Food prices going up, energy prices going up, wages going up. However, in the 70s, productivity growth absolutely collapsed. And I think that's the big difference. But in the short term here, we clearly have not just only a base effect, but we have a demand shock effect, which has created a supply shock effect. And I think we are going to be shocked at some of the inflation news over the next few months, both on the CPI, deflator, and wage basis.
Ed, I think I speak for all of us. It has been way too long.
Yeah.
Come back soon.
Absolutely.
We're thinking Thursday, Ed.
Jardini Research President. Going into payrolls Friday, talking about the dynamics in this economy. Yields are up 2 basis points on 10s to 161, call it 162. Ed talking about the bond vigilantes making a return. Well, they're not back in Japan. The 10-year Japanese government bond today did not trade. It did not trade. No trading for the first time in a year. And Tom, it wasn't because the market was shut. There just wasn't any trading.
There's no trading, and it has to do with just a bankrupt policy. I've heard a lot of people talk about this. It's just not good. You need price discovery within a system. And granted, the U.S. system, Cameron Christ has been brilliant on this. The U.S. system right now, John, is original to say the least, but at least there's movement and price discovery every day.
It is not in the JGB market right now, Lisa.
Well, how do you do price discovery when you've got a whale in the market at all times that's getting bigger? How do you deal with price discovery when central banks are discovering the price for you, John? I mean, this is the conundrum.
They are the price-insensitive buyer, and they are the whale. And I agree with you. I think, Lisa, it makes it very, very difficult. What's happened in the JGB market, though, volume, just not there.
John,
no trading.
How big is the ISM today? I mean, help me here. I don't watch it.
Just in terms of the direction of travel and the concept of peak growth, which seems to have got everybody's attention.
It's like a big
peak
deal,
rates
right?
Of growth. I think it plays into that, for sure.
I think it also gives some sort of sense with respect to supply chain disruptions. And that, I think, is a key concern with respect to the frictions of getting the economy back online.
Prices paid, finding the right labour market, the hiring story, all beneath the surface in the ISMs we've seen over the last several months, the PMIs as well. Your yield, 161.81 on a 10-year, up around about a couple of basis points. Your equity market advancing on radio, on TV. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden will unveil plans aimed at reducing the black-white wealth gap. That will happen today in Tulsa, where the president will mark the 100th anniversary of a massacre that took place in a prosperous black neighborhood. President Biden is expected to offer proposals aimed at boosting home ownership and helping minority small businesses. China has taken its most substantial move yet to rein in the surging yuan. Beijing is forcing banks to hold more foreign currencies in reserve for the first time in more than a decade. That effectively reduces the supply of dollars and other currencies on shore, and that puts pressure on the yuan to weaken. Tension over Iran is set to rise after two confidential reports from the International Atomic Energy Agency. One says that Iran has continued to stonewall diplomats investigating decades-old traces of uranium found at undeclared sites. Another says that Iran is blocking IAEA monitors from doing their jobs. The reports were circulated as Iran and global powers negotiate reviving the 2015 nuclear agreement. Two big private equity firms are taking cloud company Cloudera private. Affiliates of KKR and Clayton, Dubilier and Rice will value Cloudera at about $5.3 billion in the all-cash transaction. That would represent a 24% premium to the company's previous close. Cloudera's largest shareholder is activist investor Carl Icahn. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
He has expressed to me and to our group numerous times his desire to work with us and to negotiate a package. And I think that's what you see in facts that we're inching towards one another. I understand there's a deadline here. I understand at some point if we don't get there, but it won't be for trying. It won't be because we didn't try.
It won't be because we didn't try. Senator Shelley Moore Capito speaking on Fox News over the weekend. From New York, this is Bloomberg alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. 7:30 Eastern, just around the corner. Before we get there, 7:18. That's just how time works. Do you like that?
I like
Making
that.
no sense this morning at all. I sound like Tom Keene. I'm up 22 points on the S&P 500. We advance a 0.5%. I've been away from him a couple of days, Lisa. This is what happens. Yields higher by a couple of basis points to 161.30.
We had a cast of thousands replace you on Friday.
How did that work out?
It was just,
Were they auditions to replace me?
I don't know. I'm not going to go there.
Did you line that up? Let me get to AMC Entertainment, as if this isn't entertaining enough. AMC up by 10.9% of the pre-market, 28.97. So doing a capital raise, guys, to Mudrick Capital, but issuing that equity at a premium to the close on Friday. And the company, the CEO saying it's time for the company to go on the offense again. They're talking about buying up theatres, real estate. They're discussing maybe exploring deleveraging opportunities as well. The stock is positive after a capital raise, a share sale, Tom.
Yeah, and Paul Sweeney, who's really expert on this, said this is a great, great mystery for Hollywood. They really don't know how theaters are going to work.
How will they work? And Lisa, you raised this question as soon as that capital raise dropped on the Bloomberg.
Yeah.
What does this company look like?
Well, I mean, are they going to buy more theaters? Are people going to be rushing back to movie theaters when they have 14 streaming services at this point? Do they want that collective experience? Honestly, I wonder how much, and John, you raised this point, this idea of will Mudrick use this as a way to buy up distressed assets, like, for example, movie theater companies and the actual infrastructure, potentially sell it at a higher price.
AMC, a distressed asset vehicle. TK, what do you make of that?
I make of it is it's kids on couches with laptops moving around prices, and AMC's being opportunistic about it as they should. Right now, let's be opportunistic about Washington, the talk shows, including the senator from West Virginia. Well, entertaining. Our Jet Fitzpatrick is Bloomberg infrastructure reporter and joins us this morning. To me, Jack, it's really simple. It's the get it done of the Republicans versus some of the emotional infrastructure of the Democrats. Maybe it's about bridges, roads, tunnels, and the Democrats say don't take out the lead pipe funding as well. Emotionally, how far apart are these two parties?
Emotionally, they're not too far apart when Republicans are talking to President Biden. The issue that Republicans have cited over the last month or so is that they get closer and closer together and are in a very good mood on both sides in terms of finding common ground and just focusing on what they agree on. And then afterwards, the rest of the Biden administration will push for something a little more partisan that Democrats want. So if there is a meeting this week, as there is expected to be between Republicans and the president at some point, the emotions are pretty positive and the mood is good. The question is, can they actually follow through on that and actually turn this into legislative language that both sides agree on? But the mood tends to be good when there is a meeting between Republicans and President Biden.
What is the number one roadblock to split the difference? Let's go.
How much of this gets paid for with money that Biden doesn't want to use? Does it rely very, very heavily on using unspent money from the stimulus? Is this really new money? Is it $1 trillion or so in new money, or is it $1 trillion in overall spending plus or minus $700 billion that's taken away from something else? There's a pretty big delta between the two sides in terms of the amount of money they want to use, but how much of it is pulled out of something else that Republicans want to take from, like the unspent stimulus funds.
Jack, how much momentum is there behind this right now?
It seems to be slowing a little because of the impatience from Democrats. The mood can be good, but if there are enough Democrats saying these proposals from Republicans aren't serious enough and we're running out of time, then you start to lose momentum. And we could really see the momentum stop as soon as later this week if we don't see them really push through this. So I would say it's slowing down as of right now.
Meanwhile, internationally, there's quite a bit of momentum around a number of different relationships the U.S. has. We've been talking about China for the bulk of the morning. There is also a question about reinstating the Iranian nuclear accord. There was a sense that perhaps we were getting close to doing that. Where are we on that front?
Yeah, that's something that you're correct to say. There's a sense we were getting closer to that. That's an area with a lot of partisan disagreement right now in Washington, and I'm not sure I necessarily have a concrete update on what comes next, but it is something that seemed to be an issue that the Biden administration was at least inching forward on, but I don't know if we're going to see news on that in the very, very near future.
Jet Fitzpatrick, does West Virginia get an airport that'll rival Dubai?
Depending on how they work out the earmark system, this has been a joke. I know a lot of people have told that West Virginia is going to look like the city of the future by the time they're done with Joe Manchin's earmarks. There are going to be some limits on exactly how much they can do for one or two members, but West Virginia is really in a key position here, with Shelley Moore Capital leading the talks and Joe Manchin backing her up and insisting on bipartisan talks. So it's probably going to look pretty good for West Virginia.
Jack Fitzpatrick of Bloomberg Government down in D.C. Tom Keene, you're on form this morning. Kids on laptops moving around stocks, Dubai Airport International in West Virginia. Which one do you want to start with?
I don't know. I survived the weekend.
You got through it?
Yeah, I got through the weekend.
Let's talk about the kids moving around stocks on laptops.
It's a good point.
Look, you're talking about AMC.
They're making more.
Okay, but is it still what you just alluded to? Is it something much more than that now?
No,
and I would argue if the likes of Mudrick Capital are getting given the way they are, I'd say yes.
Look, the kids wake up and they're looking at Bitcoin and then they're trying to get a Doge quote and they're upset they can't get it off the Bloomberg. We don't have it because it's not real. 36,000 on BitDog.
Wait, hold on a second. Tom, you actually have a point, though. And I will say this, John, that the idea that Mudrick wants to get involved when the shares are valued as highly as they are gives them the ability to raise more money, to sell them at potentially a higher price and then use the cash to do other things. There is a lot of ways for them to play a company that is in the popular eye because of kids moving around stocks on their laptops.
I mean, we're talking about the equity, we're not talking about the credit. Have you seen the trip the credit market's been on?
Yeah.
AMC debt. I mean, some of the debt that was issued back in 2017 dropped to as low as, I think, below 10. And now it's back to 75. And some of those maturities are higher than that for various reasons, of course. And I won't get into the dynamics of the credit market. The cheat guide to this, Lisa, is we collapsed. We were talking about bankruptcy.
Yeah.
And then we ripped back.
Yeah, and there's a question of whether they are proven yet to be a comeback story, because people are not really going back to the movie theaters yet in force. And what is that business model, as you both have been talking about?
Are they going to go back?
But are the masses going to go back in the same kind of way? Frozen sing-along. John Ferro wants to do that this weekend.
Kids are captivated by that, aren't they? Can
you
nephew
imagine?
Can't get away from it. Just stares at it, hypnotized.
Tom,
what
can you
is it
imagine?
about that movie?
John at a sing-along of
Frozen.
any sort?
No.
Tom would go.
Tom's had enough kids for me. So I'm just going to average it out.
No, John, my highest recommendation.
This is Bloomberg. From New York City for our audience worldwide, good morning. Tuesday morning, price action like this, up 23 on the S&P, advancing 0.6%. On the Nasdaq, up 0.4%. On the Russell, your outperformance on the small caps this morning, up 0.9%. All-time highs in Europe on this side of the Atlantic, not too far behind. Switch up the board, get to the bond market. Remarkable stability in the bond market. We have not traded in Japan on the 10-year in today's session for the first time in about a year. I guess the real headline is it's not the first time we've seen that happen. We've seen it a few times over in the JGB market. The 10-year nominal yield has also been a snooze. When we topped out at the end of March on a closing basis at 174, we've talked about this repeatedly on this program, we're back to 160, 130, and that is basically your average over the last couple of months. Many people believe, though, that because of the amount of debt the Treasury's got to issue, that one of two things has got to happen. Either yields are going to go higher or the dollar's got to get weaker. Well, right now, your nominal yield's not doing much, so does the dollar have to get weaker, and against what? Finish on this. Dollar China over the last year with a big move lower into the Chinese currency's favor, a move of more than 10%. And then the Chinese come out with more than just a verbal pushback, some real policy, asking the banks to hold more in foreign exchange reserves. Looking to put the brakes on this one, TK, with dollar China down to about 638. But if you need to see a weaker dollar to fund that deficit, who's going to absorb the stronger currency? The Chinese don't want it. They've taken it so far. Will the Europeans take it? Will Japan?
The answer is no, and the answer is there's always a race to the bottom, a race to weakness on the currency markets. It's out there, it's a fact, but I would suggest, John, what we've seen in the ending weeks of May is a Pacific Rim strength that has been really noted, led by renminbi, but really other currencies, ex-Japan as well. You know, John, it does redound back over to the equity markets.
Yep, and equity futures this morning are positive. Even with this story just playing out in the background, I think it's the one to watch, 638 on dollar China. Let's get you some movers and say good morning to Romain. Morning, Romain.
Hey, good morning, guys. Yeah, the S&P is moving a little bit higher here. Volume, though, is still relatively light here. When you look at the top of the leaderboard, not only in terms of what's moving, but also in terms of the actual volume and value, it's a lot of energy stocks at the top of the board, like Devon Energy, Occidental as well. Devon Energy up about 3% here. You've got this day here where you've got crude oil here, WTI crude, well back above that $68 level. And, of course, over there in London, you got Brent crude camped out above 70. These are back at those 2018, 2019 levels here. Of course, waiting on word out of that OPEC Plus meeting. That could be another potential catalyst here, up or down for some of these names. A big deal here for Cloudera. Not a huge deal. $5 billion here as far as the actual valuation. KKR taking this company private. Remember, Cloudera was supposed to be the big open source challenger to a lot of these cloud companies like the Microsofts, Amazons, Googles, et cetera, except they just really weren't able to sort of trade punches with them. So they're going private. Those shares up 24% here pre-market. And AMC getting another bid here. Had a private equity offering here that priced about $1 above where it closed on Friday. Those shares higher by about 11%. Company says it's going to use those proceeds for acquisitions and to deleverage. You flip up the board, take a look at a few other quick names. A downgrade here for Lumentum, some concerns here about its relationship with Apple. An upgrade here for Affirm Holdings, the company saying that it's, the analyst saying that its partnership with Shopify as well as with Peloton, that's actually going to be a big beneficiary here. And keep an eye on the EV stocks. You got some data out of NIO and XPeng over the weekend. This is the Chinese car automakers. NIO's sales were up about 100% here year over year.
Yeah, over the weekend, some buzz there on Affirm and Klarna and the rest of it as well. Romain Bostic, thank you so much. Greatly appreciate it. How do we, on a June morning, synthesize what we're seeing, the dynamics, the Newtonian plumbing, if you will, of the financial system? Well, it always redounds back to the dollar. Let's take the conversation that we just had with the giant Edward Yardeni about inflation, and maybe it's cost push, maybe it's demand pull. Zachary Griffith has to synthesize this for Wells Fargo. Zachary Griffith, how do you get from inflation guesstimates to yield guesstimates over to the dollar?
Hey, Tom, thanks for having me. Yeah, so that's really the big question. And for us, we see
inflation rising, and that should push yields higher. And that's, part of the story that really comes down to the global reopening. We have a very tolerant Fed with higher yields and very heavy supply, as you outlined earlier. As far as the dollar goes, we think that dollar weakness is what we're going to see for the next month or two. And again, that comes down to a Fed that's really been the most resolutely dovish of the major central banks. And at the same time, you have this U.S. exceptionalism story fading, where other major economies are picking up from both a public health and economic perspective. So that's kind of how we see things unfolding over the next month or two.
As a rates guy, what dollar pair or dollar index do you use as your litmus paper for the American system?
We really keep an eye on the DXY and certainly seen that come off quite a bit. And we've been in the camp that we should see dollar weakness for about a month now. We think that that could last another month or two as the factors that I just outlined really play out over that time frame. And then just with respect to our target for the 10-year Treasury yield, we think that that's going to continue rising again toward the middle of the year and could hit 1.85% by the end of this month. So that's a target that we took down a bit. We were a little bit more aggressive, but it seems like this recent range has been pretty sticky. So we kind of had to reset our expectations, and that's where we see things going over the next month.
Zach offered a very basic framework outline that many people are pushing to think about the Treasury market at the moment. To fund this deficit, we either need higher yields or a weaker dollar. Is it as simple as that, Zach?
Well, from the higher yield perspective, we think so, and that really just comes down to the supply-demand dynamics. And you really saw some of that play out in the first quarter, specifically in February. You had a couple auctions. The 7-year auction had some of the worst stats we've seen in a while. So we think that you've seen some episodes of duration indigestion, and that's sort of faded a bit. I'd say the auctions last week went fairly well, but this supply story is kind of a longer-term one that we expect to play out gradually, and that's what's really going to push yields higher is you need to get paid more to take down all this debt.
Well, just how tight is the relationship between the deficit and Treasury yields historically, Zach? How tight is it?
It's been a strong one recently, and I guess it's been stronger from the analysis that we've done with respect to the shape of the curve. You really see the back end steepen when deficits are rising, and we've certainly seen a huge increase in deficits over the past year. The issuance patterns have been a bit different, with bills really doing most of the heavy lifting last year, and we're shifting that out to coupon debt as we really term out the debt that was used to finance the CARES Act and other bills initially. So we think that terming out all of this duration, again, it's going to come down to yields need to rise for market participants to be willing to take all of it down.
Zach, we've gotten a lot less certain about the likelihood of an infrastructure package getting passed, and the size of that infrastructure package has come down as time has gone on. Has that already been priced into market? I mean, could there be, for example, surprising dollar strength if there isn't some massive infrastructure plan that is passed that increases the deficit to the degree that people expected?
That's a great question. I think that expectations have come down quite a bit, and you've had the two packages out there totaling nearly $4 trillion, and we've been in the camp that we could get another deal by, call it September of this year, maybe a bit later, but it's going to be much smaller than the two that were originally outlined. And I think expectations have come down and are more in line with what we had been originally thinking. And again, it's going to come down to Congress has had a tough time getting around another package when you have economic growth coming up so much. You have deficits so high already. But when it comes down to the economic impact of these different packages, it's going to be much longer term than the COVID relief we've seen. So as far as the market reaction, we think it's going to be much less severe than what we saw when we were throwing around COVID relief deals that were very deficit financed, and the spending was very immediate in most cases.
How high can U.S. yields actually go at this point based on the foreign flows that we've been seeing into the United States from countries like Japan, which we've been talking about, and Europe, which have incredibly low, indeed negative yields?
Yeah, that's a great point. And we think that's a big reason why yields will rise, but not tremendously so. When you look at U.S. Treasury yields on an FX-adjusted basis, they're extremely attractive for both Japanese and European buyers that hedge at least some of the currency risk. So we think that's definitely a factor that puts a ceiling on how high yields can go. But with a very tolerant Fed, and that was something that we did not expect to see when rates began to rise in the first quarter, the rhetoric around that out of Fed policymakers was very receptive. And I think my favorite quote was from Chairman Powell calling it a vote of confidence in the U.S. economic recovery. So I think that with the Fed more comfortable, it takes the ceiling a bit higher. But again, the foreign dynamics and the buying that we've seen definitely puts something of a soft ceiling on how high we can go.
Zach, got to leave it there. Thank you, sir. Zachary Griffiths there, Wells Fargo senior macro strategist. Not just a tolerance, but it was almost an endorsement from some Fed officials earlier on this year when yields started to rise, and they said it was consistent with the brighter outlook. What surprised me, Tom, was to hear that from an ECB official. Executive board member Isabel Schnabel, I believe, speaking to Reuters recently, and this was the quote: "Most importantly, recent yield developments were more clearly related to an improvement in the Eurozone growth outlook rather than foreign spillovers. This is precisely what we would expect and what we want to see." I, for one, was surprised to hear it from an ECB executive board member.
Well, you're going to see it through Euro 123, and we're not there yet. You can get there very quickly. We can go there in 1 or 2 days as well. John, I would do the correlation here of June is busting out all over, and maybe my headline for today is commodities are busting out all over, affecting Europe as well. The Bloomberg Commodity Index up 20% year to date. From the bottoms, it's up 56% roughly from the pandemic lows. And even from where we were before the pandemic, John, commodities are up a robust 16%. There's something going on here more than pandemic analysis.
And the threat of a weaker Chinese currency is doing nothing to dent the appetite of this rally this morning, Lisa.
Yeah, and there is also a question about how much of the increase in prices has been transitory due to some of the supply chain kinks, due to the fact that we've had cargo ships that have been stranded on the seas due to the pandemic, and how much is due to a new regime where we're building more stuff, we're buying more stuff, we are having bigger footprints, and thus the price of stuff.
And it's the US driving this cycle and not China. It's a real change from what we saw coming out of the last crisis. Tom, you still playing that drinking game? I've got you at the corner of my eye. You hear transitory and drink.
Yeah, well, we went to more of a summer thing with Tang Mimosas, and it's working out.
Tang Mimosas.
Yeah, it's working out
Nice.
great. I mean,
it sounds really good. Enjoy.
Do you force your kids to eat Tang?
Actually, no. Well, it's not champagne. It's cold duck, but that's.
What's it called?
Cold duck, John.
Coming up,
John.
Janine Way,
Cold duck.
Barclays senior
A beverage from
analyst.
years ago.
You can tell me more about it in a minute.
It's back.
Up 22 on the
Think
S&P.
Crosby, Stills, Nash and Young, deja
up a
vu.
half of 1% to 42.24.
1970.
I hope you all enjoyed.
Cold duck. Would you like to listen
the last
to
couple of days? Welcome back from New York. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. U.S. oil futures climbed to their highest in more than 2.5 years today. West Texas Intermediate rose as much as 3%. OPEC and its allies are forecasting that the global market will tighten up. The cartel says the oil glut built up during the pandemic has almost gone. And higher energy prices are one of the reasons inflation in the euro area climbed to the highest level in more than 2 years. Consumer prices rose an annual 2% in May, more than economists had predicted. A separate report said that factories lifted their prices by the most in more than 18 years. And there's a report that Japan will allow some spectators at next month's Summer Olympics, according to TV Asahi. Organizers will let domestic fans attend the games. Spectators will be required to provide a negative virus test or a vaccination certificate. Fans from overseas would not be allowed to see the Olympics in person. In tennis, women's star Naomi Osaka has dropped out of the French Open because of a dispute over mandatory press conferences. Osaka said in a social media post that she suffered from depression and social anxiety disorder. She says that taking part in press conferences makes matters worse. Osaka is ranked second in the world. And Krispy Kreme is set to become a public company for the second time. The American donut shop chain publicly filed for an IPO on the NASDAQ. JAB bought Krispy Kreme for more than $1.3 billion in 2016. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
Boeing has delayed the deliveries until 2023, and we are fine. If they can deliver it to us in 2022, we will accept them. The only problem we have is there is a stress in the supply chain for the entire aviation industry, and I hope that that will be resolved.
Pick a sector. We've heard that last line on repeat. That was the Qatar Airways Group CEO speaking to Bloomberg from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's the equity market as we kick off the month of June. Up 22 on the S&P. We advance 0.5%. 161.64. Yields are higher by a couple of basis points. You could clip and repeat that line too. Euro dollar 122.19. We're down 0.1%. Just a slightly weaker euro here, Tom. Crude 68 handle.
Very quick.
WTI 68.25.
John, very quickly here at 4224, Standard & Poor's 500. Remember how absurd not that long ago 4,200 or 4,500 felt?
Ridiculous.
On
Tom.
Standard & Poor's.
When people were putting together those year-end forecasts on the S&P 500 back end of October, early November, developing the year-ahead outlook, then the headline dropped around some of the efficacy for Moderna, for Pfizer, changed the game. What surprised people, I think, is not the cyclical rally. It's just how well tech actually held up. That tech didn't collapse and fall away, which would really weigh on the index in a massive way. The tech held up and everything else had a rip.
And John Stolfus very strong on the idea of tech having a better back end of 2021. Dow up 36%, SPX up 38%, NASDAQ Composite up 45% year 12 months trailing. Dave Wilson has these numbers tattooed on his left arm. He also knows it's about the fundamentals of earnings, I should say, rather. And you've got an earnings update here is 512 of the S&P 500 reported.
Well, actually, our number, as it turns out, is 489. We don't necessarily get 500, it seems, every quarter, so we have about 10 left to report. But what's really striking is you're looking at a third straight quarter where companies way ahead of analyst estimates when you look at earnings, and yet getting no reward for it. In this particular case, if you look at the first quarter numbers, on average, shares moving the day after reporting, when companies were beating estimates for the first quarter, they rose less than 0.1%.
But we're up 38%, 12 months trailing. And once again, the market gets out front with the expectation.
Oh, yeah. I mean, that's definitely part of the mix here. And it's also the anticipation, perhaps, that what we see looking forward is not as promising, perhaps, as what we see looking back at these quarterly results, comparing them with estimates. One thing you can say, though, is that really quarterly results have become a one-way street for companies in the sense that, you know, if you come up short of projections, your shares still fall. On average, you look at the S&P 500, down 2.2% the day after reporting results when the earnings came up short. And that's in keeping with what we've seen now for several quarters. So, you know, that's consistent. But, you know, in terms of beating projections, the last 3 quarters, companies haven't gotten any benefit. In fact, for the fourth quarter results last year, they actually fell on average in response to results. So it just shows you how things have gotten arguably out of whack. You know, you're talking about how much stocks are up in the last 12 months. That's part of it. Clearly, the effect of the pandemic on earnings and on estimates is part of it. So when you put it all together, it's clear that, you know, there's not a whole lot companies can gain at this point by coming out ahead of projections.
But Dave,
it really is an issue of what happens when they come up short.
Is out of whack really the takeaway here, or is it that it is priced in, that people have already priced in such an optimistic future and brought forward the future to now when it comes to the pricing, that it requires some massive, massive shift in the business model to a more optimistic trajectory in order to get stock investors excited?
You're onto something, Lisa, no question. And it's about the forecast. In a lot of cases, you know, companies talking about how numbers may come up short for their current quarter or their year, you know, or finding some issue in terms of, you know, their profitability, you know, especially when you look at the, you know, higher costs of labor, of transportation, those sort of issues. So it really is a matter of kind of looking ahead and perhaps not seeing quite the optimism that's already built into share prices, no question, but is also built into these quarterly results when you compare them with estimates.
David Wilson, thank you so much. Greatly appreciated this morning. You know, the Deutsche Bank story, John, that just came out here on work from home, I mean, it really talks to where we are in June. And, you know, to be honest, to me, it's a mystery to get to Labor Day and certainly into 2022. Every company has a different formula.
They're going to inform staff on work from home rules, Tom, in due course.
Due course.
They've had 12 months to work out that. Unveiling this hybrid model for post-pandemic work.
I'm thinking.
Haven't we been doing that?
Didn't we get due course? It was an email, single sentence.
Yeah.
Somewhere coursing back to November of last year.
Maybe April, May of last year. Lisa, you identified the difference as well, the transatlantic difference between how the European banks are playing this and how they're playing it on Wall Street.
Yeah, in Europe, they're basically saying, great, work from home, we'll cut our footprints, we'll reduce costs. In the U.S., they're saying, get back to the office. There's an office culture. There is more productivity in the office. What I find interesting is from an investment standpoint, offices have come back much more when it comes to valuations than, say, brick and mortar retail. And this, to me, is a real question. Why should that be? In other words, if offices are going to be subject to the same dynamic as malls, why shouldn't they be as devalued as you're seeing mall real estate?
What does this hybrid model actually look like? Do you skip Mondays and Fridays, Tom? Is this how this plays out? Does everyone want the Monday off, the Friday off? Does everyone work the same days in the office? Do they rotate?
I go back to Marissa Mayer at Yahoo. Over 10 years ago, they did a study. She said, let's actually learn about this. And she was heated. Work from home doesn't matter. Heated.
Lisa?
I think that there is a bias, though, in terms of who chooses to work from home. I mean, there are a number of studies that show that people who work from home don't get promoted as frequently, but often people stay home because they have children to take care of or they're in a situation where they need to take care of things at home, so they can't work as much. There's also the question of office culture. People want to be with one another, especially if they're younger and they don't have families and other obligations.
I don't agree with that at all. If you have family and kids, you want to be in the office more.
Sure. It's the question of whether you can. Do you want to talk about your weekend, Tom?
I think Tom wants to talk about a range of things this morning. The other thing is hitting the road and making a sale. Making a sale.
Yeah.
We've been discussing that a million times, haven't we? If you're willing to get out and see a client face to face, Lisa, surely that gives you the edge.
And you're seeing business travel pick up again. My question is there going to be internal company travel that won't necessarily happen, right? I mean, is that the marginal business travel that's not going to come back? And the rest of it we're going to see come back because you're already seeing that happen.
Not going to go to the local restaurants and come by our team meeting that nobody really wants to be a part of.
Small
team
talk.
outing that nobody really wants to go on.
You know what I've seen from all my friends? None of them have patience for the small talk or the relationships on the periphery that they didn't necessarily want to begin with.
That doesn't surprise me that your friend group doesn't have patience for small talk. At all.
I want to say anything else.
Just knowing you, Lisa. I think we should move on from this. Brent Shooty is going to help us do that
We should
a little
too.
bit later from Northwestern, the mutual chief investment strategist. We're looking forward to that conversation.
We are.
Before
It's
we
gotta
get
be
there,
better than this
equities up 22 on the S&P, 42.24, up a half of 1%. I've always said the commercial breaks of this program would be a million times better than the show itself. Yields up a couple of basis points on a 10-year to 161.47. Euro dollar unchanged at 1 and all the twos, 122.22. We're unchanged there on crude, 68.32 on WTI, up a little more than 3%. On radio, on TV, this is Bloomberg Surveillance.
Everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
If people expect inflation, then they're more willing to accept it.
The risk-free rate right now is manipulated by central bankers all over the world.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television, a simulcast on a most interesting start to June. And I'm going to go to Broadway, John. Commodities, they are busting out all over.
Thanks for that, Tom. We're up more than 2% on Brent. On WTI, up by about 3%. 68 handle on WTI crude, Tom. Brent with a 70 handle approaching 71. OPEC Plus talking up a tight market, tight labour market, maybe the words of the St. Louis Fed President Jim Bullard, and that seems to be the theme. Pick a sector, pick a commodity, pick an asset class, pick a dynamic, Tom. It will speak to the same thing.
Well, the dynamics here are real. They're really correlated. We'll get to the data here in a moment, John, but a 71 print near 5 a.m. this morning on Brent crude speaks volumes. And I know there's an OPEC story to it, John. My only question is, talking to our guests, when do we blink and when do yields, a 10-year yield, actually move and catch up with the other dynamics we see?
So far over the last couple of months, they have not. 161, 162 is the average. That is exactly precisely where we are again this morning. In the face of a conversation about budget deficits north of $1 trillion forever in America, yields 161, 162 on a 10-year maturity.
Suits and ties, Lisa, can rationalize inflation for the people of America. It's tangible, isn't it?
Well, the University of Michigan sentiment survey that came out on Friday was one of the most underplayed surveys out there. It showed that people have the expectation for 5 to 10 years of 3% inflation. Not necessarily runaway dynamics that we saw in the 1970s, but still justify a 1.61, a 1.62% 10-year yield with the expectation of 3% inflation over the next 5 to 10 years, Tom.
And John, the dynamic here on real yields, I mean, let's be honest, folks. Most of our guests are focused on the real yield. You could see that in a 4-day work week. Friday, we're looking for that Friday afternoon. But seriously, John, we just simply haven't seen the real yield coming in without inflation pushing down.
Where are we? Negative 85? Negative 86 on 10s. I agree with you, Tom. We haven't had the lift that many people expected. We haven't seen that in real yields. We had inflation expectations reprice. But even that story started to stall a little bit more recently, Tom. Even that's come in just a little bit more as well. So what's the catalyst to really change this? When is the transitory debate get addressed, get solved, get reconciled? You could be talking about the end of the year.
Well,
it could be a long time.
The other parts of the market are getting out in front of that. Let's go through the data, John, and sit on it for a while. I'm going to do foreign exchange right now. Weaker dollar, but DXY, the blended broad index, not breaking through to new weakness. Renminbi with some yuan strength, and then over the Memorial Day weekend, sets of action by the Chinese, including that stunning 3 children policy, a weaker yuan. John, what I would notice is just one proxy is Mexican peso nicely comes in, stronger peso off oil down to 19.88.
Weaker dollar theme in spots in the FX market.
Well
Euro
said.
dollar 122.26 unchanged. In the bond market, there it is for you. Up a couple of basis points, back through 160, 161.81. Equities on a nominal yield, totally stable. Your equity market with a lift up 0.6% on the S&P.
Yeah, but it's the way it's up, John. I mean, look at the Russell up 0.9%, leading the way this morning. The VIX, I'm finally getting the VIX to come in. I'm not to a 16 handle. Can you imagine a 15 handle?
Yes, Tom. I can imagine a 15 handle if this continues. I can envision what 15 would look like.
Can I throw another data point out there?
Please
and
do.
this really does have to do with the incredible environment for borrowing. Borrowing costs for investment-grade companies are now the lowest they have been post-crisis. They continue to grind tighter, now just 84 basis points. And it raises a question of what kind of risk we're building up here. The idea of what kind of buffer do you have if there is finally a move in Treasury yields, or do people not care because, frankly, they need income, they want income, we're getting older, we need that retirement, and that I think is really going to be a key dynamic.
You two sit on this for a minute because it's really important. Am I right, John, that what she just said is lesser quality bonds are less than 1% difference in yield?
Lisa was talking about investment grade, I think, Tom.
Credit?
Lisa was talking about investment grade.
Well, for a guy like me, that's lesser quality.
Well, yeah,
compared to Treasury, sure,
sure,
but compared to high yield, no. I just wanted to be really clear that we weren't talking about high yield, we were talking about IG. We've had a ton of supply to match some of this as well, particularly in high yield. I think junk was a record for the previous month, the month before that, at least the month before that.
Well, and the reason why is because energy companies were actually the main ones that were driving the most recent borrowings there, because borrowing costs have gotten so cheap and energy costs have gone up. The question is, again, what are we building up? We have companies that are leveraging themselves up to the old economy in a regime of low rates that may not stick around. Yes, this is the big debate.
Careful, Lisa, with that word. Sorry to interrupt. Forgive me. Just careful with that word leverage, because a lot of this issuance this year has been refinancing, not additional leverage.
Well, refinancing, though, from 2020. Right, refinancing from the amount of cushions that people, that companies tried to get to survive the pandemic. The question now is, are they going to grow into this debt that they incurred to survive a public health crisis, right? Yep. And so, yes, they are more leveraged than they were pre-pandemic, although perhaps they're not increasing leverage at the same pace this year.
It's a very good point.
I'm confused. Joining us now, Brent Shooty, Northwestern Mutual Wealth Management. And what's so important here, folks, is you have to recalibrate, not mid-year, but but maybe June 1st will be a good point to do that. Brent, I want to go into the depth of your note, where one of the great opportunities here from Milwaukee to the Pacific Rim is to buy up emerging markets. So much of our radio and TV audience is behind. Is EM the place to catch up?
Well, I think international in general is a place to catch up. And so if you think about it, we've had this broadening recovery in the U.S. in the back of vaccinations, stimulus, and reopening. And now you're seeing that push into places like the Eurozone, where they're now having increased vaccinations. Their manufacturing segment is doing very well, and soon their services segment will be doing very well. And so you're going to have reopenings occur in the Eurozone. And I guess more in general, I think as we continue to think about the next part of the recovery, it is more based in the international part of the world where they're just a bit behind the U.S.
Whereabouts, Brent? Because Europe right now is trading at all-time highs on a stock 600. What's been lagging? What hasn't participated?
Well, I mean, I think if you look past the last year or so, I think Europe in general has lagged, and that's because their economy has lagged. And they're now starting to do stimulus. They weren't doing that before, certainly. They're sharing debt more so. And so I think you're going to see a European economy that pushes forward at a rapid pace. And I think that's going to draw more investors in, because if you think about the past 13 years, and you guys have mentioned this with the Treasury trade and everything else, investors have learned not to invest overseas. And they're still extremely reluctant to move anywhere outside the U.S., especially growth. And now you're going to see that narrative change a bit. And every economic expansion is different, which means every market expansion is different. And I think this one's going to incredibly push more towards those international economies in the coming quarters.
What's the main factor, Brent, that you look at to determine which economy is further along in the cycle? Is it vaccinations? Is it the central bank and the tightening cycle? There are a lot of different competing factors here.
I think all the above. But even just take you back recently. I mean, the U.S. in the first quarter posted, 6.4% growth, I believe. The Eurozone posted negative. And so if you look at their output gap, for example, which I think is a summation of all those, their output gap is bigger than the U.S. Leading economic indicators in the Eurozone are actually down, not up like they are in the U.S. And that will actually occur. And I think this cycle has been a little bit easier because it is more along the line of COVID cases and shutdowns. Now you're going to see that starting to reopen. And I suppose I could add one more for you for those people who want to do so. Look at the Oxford stringency indexes that show how much government regulation or tightening there is based upon COVID closures. And those will actually start coming off the boil a bit in the Eurozone, and that should actually have the same impact it did in Q1 in the U.S.
Right. Brent, do we need to make bet here? I mean, in speaking with Northwestern Mutual and a more conservative idea, do we need to make bets here and strategic guesstimates out 2 years or 5 years, or do we risk an over-diversified portfolio where we've got too many ideas at play at once?
Well, certainly we look at the next 12 to 18 months heavily and how we make our tilts and our shifts of our money. I think all the things that you guys mentioned in the opening commentary between you, Lisa, and Jonathan are all out there. I think they're out there 2+ years. And so you do have this period of time, I think, right now where the markets are probably going to slow down. I don't think that's a big comment based upon the pace that they're at. But certainly I think this could be a very quick cycle, and we'll see what that actually causes. And some of that debt that's building up, the question of inflation is going to be incredibly huge. I think it's temporary right now, so I'm more consensus. I think it pulls back, but then I think it's more of a 2022 issue. And I think that is actually an issue of this expansion because monetary and fiscal policy have adjusted to all those demographic headwinds that everyone talks about, and you're actually having societal shifts towards actually inflation preferences. And so I think that's more of the next 2 to 5 years that you mentioned, where those concerns are going to be much more prevalent. I think right now you still have some time left.
Brent, just quickly, when you say a quick cycle, quicker than what we saw before in the previous cycle, which is probably easy to say, relatively speaking. Quick, what does that mean?
So we're still probably early cycle. We could be mid-cycle to late cycle in the next year or so. Think about the jobs market and recovery we're likely to have there. You're going to see big job gains, and you could be at full employment in the next year. That is incredibly quick.
Brent Shooty, Northwestern Mutual Wealth Management Chief Investment Strategist. Really important point, Tom. And that's the theme that Morgan Stanley's been getting its hands around for the last couple of weeks, couple of months. This idea that it's early cycle timing, late cycle valuations. Well, that's a difficult tension to resolve.
The timing here is simple. There's a lot of people that have rationalized not participating. And the fact is the people who are winning. There was some zeitgeist on this over the weekend. If you're not in this market, you've missed the boat. And you see it again this morning. I mean, John, the character of the equity bid here, it's a solid bid on this first day of June.
Small caps outperforming on the Russell, the S&P up by 0.5%. Lisa, the NASDAQ up 0.4.
How do you have conviction when we have the incredible swings swings that we've seen in the surprise index, the idea that it's been so hard to pinpoint the reasons behind the frictions that we're seeing. How do we determine where we are in the cycle? The disagreement there, it just is such a hard time to have any conviction with respect to any of these calls, because this is a unique moment in economic history.
And that was the conditioning of the last 12 months. Have conviction about nothing. Just try to stay humble about the moment we're in. Kathy Jones of Charles Schwab suggesting, and I'll catch up with Kathy a little bit later this morning.
Oh, you will?
It might be until August, September when you see the big jobs gains.
Yeah.
You've got to wait for the back to school, Tom.
Well, yeah, the back to school, I mean, you can see it in the trees. You can smell it in the breeze. June.
Okay.
He's busted out.
You've got more time here. Got another 10 seconds if you want.
Commodities are up.
Keep going.
To the moon.
No.
Beautiful.
Oh, boy.
42.25 on the S&P. Tom's here all week. This is Bloomberg.
Busting out all over.
With the First Word News, I'm Rishika Gupta. President Biden will unveil plans aimed at reducing the black-white wealth gap. That will happen today in Tulsa, where the president will mark the 100th anniversary of a massacre that took place in a prosperous black neighborhood. President Biden is expected to offer proposals aimed at boosting home ownership and helping minority small businesses. China's taken its most substantial move yet to rein in the surging yuan. Beijing is forcing banks to hold more foreign currencies in reserve for the first time in more than a decade. That effectively reduces the supply of dollars and other currencies on shore, and that puts pressure on the yuan to weaken. Two confidential reports from the IAEA raise questions about whether Iran is being transparent about its nuclear activities. Next week, those reports could lead to a formal censure from the agency's board of governors. At the same time, Iran says it hopes the 2015 nuclear deal can be revived by August, when President Hassan Rouhani's administration ends. Rouhani is expected to be succeeded by a hardliner who will be more hostile to the deal and the U.S. Two big private equity firms are taking cloud company Cloudera private. Affiliates of KKR and Clayton, DeBillier and Rice will value Cloudera at about $5.3 billion in the all-cash transaction. That would represent a 24% premium to the company's previous close. Cloudera's largest shareholder is activist investor Carl Icahn. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
There is a strong recovery of oil demand. United States, China, Europe, and elsewhere. And if the oil producers, OPEC Plus, stick to their current policies, we may see a widening gap between supply and demand.
It's the theme of the moment, isn't it? That was Fanny B-Roll there, the IEA Executive Director, talking about the crude market from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Up 22 on the S&P, we advanced 0.5%, and there's the move on crude. 68 on WTI. And just for you, Tom, perfect timing, 71 handle on Brent. $71.04, up 2.5%.
Moving up off of the 5 a.m. number this morning. Let's get right to it. This conversation is too important. Janine Wei is chemical engineering out of Berkeley and has put together a storied career in the sell side of integrated oil, actually looking at the American oil companies. Janine, I got a whole bunch of ways to go here, including the climate change uproar at Exxon, but I do have to focus at $70 a barrel on the responsiveness and dynamics of oil price to, say, ExxonMobil's free cash flow. Is Exxon a real oil company now, or are they a bank that happens to run oil? Which is it, and what are they going to do at $70 a barrel?
Thanks for having me on, Tom. That's a very interesting question. We do think they are a real company. At $70 a barrel, there are a lot of options, but I think that the main drivers of major stock performance recently has been twofold: dividend sanctity and timing of cash returns to shareholders. And so at $70, we think that it's a matter of when and not if that Exxon starts returning incremental cash to shareholders. And we think that could probably happen in 2022 because that's when they get within the range of their debt reduction targets.
Their 10-year per year return is a travesty. Their 20-year, 10-year return is how CEOs get fired. What's the new religion at ExxonMobil?
Well, the new religion is that there's been a paradigm shift in energy broadly, I would say. There's a focus on go-forward cash returns, and there's a significant high grading at Exxon for the projects going forward, which should exactly change the track record of the poor ROCE going forward. So there's a paradigm change in energy, focus on free cash flow, focus on capital discipline, and the current management team is very focused on reducing capex to the lower end of the range this year, and they've dramatically lowered the medium-term capex to 20 to 25 billion, which is about 10 billion lower than it was before. So we think that the go-forward Exxon is a much different company than the prior 10 years that you just mentioned.
How high, Janine, do prices have to go before U.S. shale producers, before marginal U.S. Oil drillers actually get back into the market and produce more?
That's a good question. I think that's everybody's fear, is that with higher oil prices comes more U.S. supply. But what we've noticed in our companies, not just on the U.S. major side, but also with the large cap U.S. E&Ps, is that the supply response has been very muted to higher oil prices. And we don't see that changing in the next couple of years. And that goes back to the paradigm shift that we talked about. Investors know that it's a now or never for these companies to prove that they're real companies, that they can return cash to shareholders. And so we think that the supply response will be very muted going forward. Generally speaking, our companies now are much more vocal and aware of the macro conditions around them, indicating that right now the world doesn't need their oil, but they're looking for global inventories to stabilize, they're looking for curtailments to come back, and they're looking for oil demand to come back to 2019 levels before they even consider growth. The one caveat there is we're keeping our eye on private production, given that it's become a much bigger part of the U.S. supply picture.
So, Janine, how much of what you're seeing with respect of discipline has to do with what you're talking about, which is that it might take some time for things to get back to the levels of demand in 2019, and how much has to do with the push by shareholders for climate change activism and some sort of response from the fossil fuel producers?
I think it's both. I think that the capital discipline is alive and well, and we keep seeing more and more data points for that. And I think the push for climate change really is making companies more aware that they've got to look at the overall macro picture. It's not just every company out for itself. And with investors demanding climate change, the energy transition is only going in one direction. So that kind of biases production lower. And let's not forget that investors are really demanding returns and cash returns on and of capital going forward, which historically this group has not done a very good job at.
Janine, what does engine number one want from the Exxon board, Exxon leadership, and do you disagree with them?
Well, we don't necessarily disagree with the nominees that Engine One has proposed. I think certainly they all have merits. And broadly speaking, I think that the market really wants to have change in the Exxon board. So I think Engine One is really looking for transparency and for more energy experience. Where we kind of differ from other maybe opinions is that we don't necessarily think that a major change in the board or the strategy of Exxon would necessarily benefit shareholders. And this kind of goes back to your first question, in that we think the current management team has done a really good job changing the complexion of the company going forward. So between one, maintaining the dividend last year when oil prices were crashing, two, reducing capex to historically low levels from what you would expect them to do, and three, most recently executing on quarters, we think that the management team is actually doing a pretty good job right now. So a major shakeup we don't think would be the watershed moment that maybe others do. But we do think that the company would benefit from lowering capex further in the near term and lowering capex to at or below the low end of their medium-term budget.
Could you put some numbers on that for us, Janine? And is this upstream capex, and how big would that cut be?
Right. So this is upstream capex that we're talking about. So, for example, if they go to about 19.5, 20 billion of capex, we think that they can get all of their plans done in the medium term and produce a decent amount of free cash flow. So free cash flow is really the key for the sector because that's how you get cash returned to shareholders. That's how companies prove that they're real companies. And so for Exxon, if they do that, what we're saying is lowering capex at or below the midpoint of the medium-term guide, we see free cash flow averaging about 3.6 billion per year on average through 2025. And that would allow them to both pay down gross debt and increase the dividend.
Janine, great to catch up. Timely conversation too. Janine Way there, Barclays senior analyst on the crude players, the likes of Exxon and more. Brent crude this morning, $71.17. We approach 69 on WTI at $68 and about 70 cents now, Tom, up by 3.6% on WTI.
As we were speaking with her, Chris Verone publishes a Strategas, and he says he has, quote, his eye on $80 a barrel. Is anybody framing $80? I don't think so, John.
The rally continues this morning. Crude higher. Equities push up by 23 on the S&P, by 0.55%, and yields up now by 3 basis points to 162.67 as small caps outperforming. That reflationary thing back just a little bit as we kick off the month of June. From New York, on radio, on TV, this is Bloomberg. From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. 1 hour away from the opening bell. Small caps outperforming on the Russell, on the S&P 500 up 0.6%. We advanced 23 points. Your headline at the moment, though, levels we have not seen since 2018 in the commodity market on crude. A 68 handle on WTI at 68.55. And Tom, Brent crude trading at $71 and almost 10 cents.
And it's some commodities. We mentioned that earlier. It's not a broad Bloomberg commodity index rise. But, John, there's enough going on there with copper and the rest. They're not out to record highs, but they're right up there and elevated where you really wonder this 56% move in commodities off the bottom of the pandemic. Will it keep going?
Copper still through 10K, bit softer on the session. Iron ore doing nicely. Iron ore up by more than 4% the last time we saw that trade. Now, Tom, look, China's not participating in this in the way it did maybe 10 years or so ago. And I think it's interesting this morning that China's basically come out engineering, maybe tapping the brakes on its currency appreciation, which you would expect to actually make a dent, take a dent in the commodity market. And this morning it hasn't in a big way at all.
No, and it's just a little bit of a reversal from a 637 yuan to a 6.38 yuan. But nevertheless, there it is as China is active. And you really think, folks, we've got to see more people active. Just as an aside, I'll point out the idiosyncratic Turkish lira out to 8.52, a continued difficult Tuesday there as well. He writes brilliant notes for Pictet of Switzerland, Pictet Wealth Management. We're thrilled that Thomas Kosturge could join us on the American economy this morning. Thomas, my mathematics is a buoyant 6.5% all in this year and a still buoyant 3.2%. We average out at 4.8, 4.9% economy for 2 years running. That's pretty good, isn't it? That's basically double the run rate, right?
Right, and that's what you would expect after strong fiscal spending, several rounds of checks. So fiscal support has been really huge, and to some degree, I think actually the economy could do even better than what it is doing now. The economy is strong, but again, if consumers were really going out and spending all that money that they've saved last year, we could go up 10%. So yeah, we're up 6.5% this year. It could be better. It could be worse though as well.
There can be leakages or surprises within the calculus of what we do. The blunt instrument is we're all going to go out and spend it. No one believes that. What's the leakage within the calculus that you're focused on? What could be the surprise to a more moderate consumption?
Right, and the equation is, we look at the pile of savings. we're speaking here at a pile of around $2.2 trillion, right? Around, $1 trillion that consumers have not spent, and $1 trillion that's the excess income that they got last year because the federal government was so generous. So $2.2 trillion. And the question is, are they going to spend it now? Are they going to wait to spend it? Are they going just to save it or repay the credit card debt? And so far, the indicators we have suggest that there is a degree of caution out there. People are saving. They're still not unsure about the recovery. There's also the so-called haircut effect, which means that if you don't go to the hairdresser once, you don't go twice the following week, right? So what has not been spent will not be spent. But bottom line is that the savings pile is there, but it will probably be spent gradually, which is good news because also it means the U.S. economy will avoid overheating.
Thomas, is that just a guess? What are the inputs that go into that? How do you know? How do you come up with a forecast for what happens with savings?
Right. So we have data. We have consumer surveys, and so far they're not that great. Actually, in Europe, consumer surveys are back to their pre-crisis levels. In the U.S., they're not. If you look at Conference Board consumer survey, the Michigan survey, and even in some details, I'm a bit cautious. If you look at housing intentions in the U.S., they're actually going down, which is a bit of a worry because people should be feeling more confident. They should spend, they should buy houses, cars, and so on and so forth. So we have data from consumer surveys which suggest some caution. We have also data about April spending. So, right, they received the checks in March, so we already know what they did in April. And in April, people were quite cautious in their spending. So if we extrapolate that, we have the outcome that I just described, which is strong growth in the second quarter. But after that, we're likely to see growth normalizing back down towards, say, around 4% in the second half of the year.
Thomas, what's the implication if we've basically had helicopter money in the U.S. and even in parts of Europe, and that doesn't lead to sustained inflation?
Right. I think one key conclusion for the next recession is that we may have fiscal policy which may put a timestamp on spending. You may be forced in the next recession, when you receive a check, to spend it within the next 3 months or 6 months. But not like, the problem with that fiscal spending in the U.S. was that, there was no, people didn't tell you that you had to put it back in the economy. And I think that was maybe a fragility or a weakness that could be addressed in the next recession. Now, in terms of inflation outlook, you don't see wage growth or, excessive wage growth. You do not see credit growth. Credit growth in the U.S. remains still subdued. And third, inflation expectations remain very much low. Okay, there's an exception in the Michigan survey, but I think that's an exception. Overall, if you look at inflation expectations, they remain very much anchored. So I do not see an inflation phenomenon kicking in. I see inflation in commodities. I see inflation in some supply chains, in some goods and so on and so forth. But there's no generalized increase in inflation.
So just to put together this idea of the conservative way that people have been using their spending, which is or their savings, which is what you're signaling with this friction in the labor market, with people not going back into the labor force. Could this be that people are using their cushion to stay home for longer, and that they'll only go back once that cushion is used up? Is this sort of part of the mystery, in your view, that we're seeing in the labor market?
Yeah, and so far, we had a bad employment report last time. I think we really need to show firmer conclusion. We need to really wait for this one on Friday. This one will really be key to seeing whether there is a genuine impact from the generosity of the federal government with regards to unemployment benefits. I think it does hamper the return to work. However, it's true there are other issues. One also is that firms have gotten more efficient in this during the crisis and during the recovery. The skills have changed as well. The economy has changed, and so you don't need the same workers that you did. The same ones that you used before the crisis. Think about the green economy. You need a new range of skills for the green economy, and those workers, the skills are not there. So that's I think another issue.
And Thomas, your inflation view, maybe it tilts to Jan Hatzius at Goldman Sachs, but I'd really make note that it tilts to David Rosenberg up in Toronto. Rosenberg looks for a disinflation, and he really estimates a go east tone. If you're going to buy growth, you've got to go to the Pacific Rim. Does Pictet agree?
Right. I mean, in terms of the recovery, definitely Asia has been, has definitely rebounded much more quickly. And also, a few months ago, it was already rebounding. So definitely Asia is the place to go for growth. However, right now, the good spot is actually Europe. Europe is recovering. The vaccination is also accelerating. I think, this summer could be a good growth for Europe. Now, in the longer run, we're still more optimistic about the U.S. than Europe, including for demographic reasons, but also the technological leadership than we really see in the U.S.
Thomas, thank you, sir. Got to catch up. Thomas Kostek
Thank
there.
you.
Really good.
Pictet,
Really good.
Wealth Management Senior Economist. Just to give you some of the numbers, put some muscle on those bones that Thomas was talking about. The growth for this year decelerating to next year. 6.5%, the median estimate for 2021 growth in America. In our survey, 4.0% for 2022. So it's that deceleration from 6.5 this year, the estimate, Tom, to 4 next year, then 2.4 for whatever a 23 forecast is worth right now. Here it is, 2.4%. Is your median estimate there?
I just emailed up to Toronto and Canada, John, with the same undershooting of the survey. You had 19 economists with a good statistic, and the number came in, first quarter number came in below.
Deceleration.
There's a lot of moving parts here, but what I don't see, John, on the Bloomberg screen this morning is the world coming to an end.
No, obviously not, with futures up 22, 4,200 on the S&P 500. But, Tom, the key variable...
I was looking at Doge, but okay.
Were you? Lisa, the key variable has got to be the savings rate. How much more will that come down? How much money will be spent? And when you really dig into it with economists, these are some big guesses.
Well, yeah, and who has the savings, right? I mean, is it the wealthier individuals who have less of a propensity to spend and really more likely to put this in the wealth bucket versus lower income individuals that are more likely to spend it? I think that the implications here have to be emphasized. The idea that if we do not get sustained inflation from helicopter money, from printing trillions of dollars of cash, what are the longer-term implications about fiscal policy? I mean, to me, John, this is a massive, massive question that we're going to be talking about for years to come coming out of this year.
It's about time, how much you let this play out to see a tighter labour market, which is what the Fed wants to do. They want to wait a long, long time for this. Kathy Jones of Charles Schwab's going to be joining me a little bit later on Bloomberg TV. We'll do that in about 20 minutes' time. We're going to be talking about when you can expect the big jobs number. Is it this week? Kathy thinks August, September. When the schools go back, that's when you'll start to see the big numbers, and you're not going to see them this Friday, Tom.
I don't have an opinion on that, but it's important the way she takes the timeline out. So few people, John, are looking at Q3 or Q4.
Pushing it back to the end of summer, Lisa.
Yeah, well, things haven't gone back to normal fully, and yet there still are so many job openings. How do you square that with all of these people still out of work? I mean, the thing that Tom was talking about, that possibly some of the skills may have changed, I find that really interesting.
We're about to see in 20-plus Republican states, haven't we?
Yeah.
We're about to see over the next couple of months what that looks like with those 20-plus Republican states removing that additional unemployment insurance. From New York this morning, good morning, up 22 on the S&P. We advanced by 0.5% on the S&P 500 to 42.25. In the commodity market, a 68 handle on WTI, 71 on Brent,
Broadway's returning.
$68.50 on WTI.
You're going to sing again?
More than 3%. Have you bought tickets?
No, I'm not.
About?
I'm singing it instead. June is busting out all over.
Nice. Euro-dollar
all over the
122,
meadow and the hill.
Yields are up 4
Buds
basis
are busting
points
out of bushes.
to 163.
In the rampant river.
This is why it's been such a wonderful partnership.
Every little wheel that wheels.
You do crazy stuff and I just ignore it. Futures up 0.5% on TV and radio.
I don't ignore it. I love it.
There, more.
This is Bloomberg.
More, please.
With the First Word News, I'm Rishka Gupta. U.S. oil futures climbed to their highest in more than 2.5 years today. WTI rose as much as 3%. OPEC and its allies are forecasting that the global market will tighten up. The cartel says the oil glut built up during the pandemic has almost gone. And higher energy prices are one of the reasons inflation in the euro area climbed to the highest level in more than 2 years. Consumer prices rose an annual 2% in May. That's more than economists had predicted. A separate report that factories lifted their prices by the most in more than 18 years. And there's a report that Japan will allow some spectators at next month's Summer Olympics. According to TV Asahi, organizers will let domestic fans attend the games. Spectators will be required to provide a negative virus test or a vaccination certificate. Fans from overseas would not be allowed to see the Olympics in person. Krispy Kreme is set to become a public company for the second time. The American donut shop chain publicly filed for an IPO on the Nasdaq. It says that sales rose 23% in the first quarter. JAB bought Krispy Kreme for more than $1.3 billion back in 2016. The company is an investment vehicle for the Riemanns, one of Germany's wealthiest families. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
One of the chief concerns I have is that as you start to see people doubt the Fed's credibility with respect to its supposed mission on inflation, some of those inflation expectations are rising in a way that's not good.
Dean Kernot, very important there with the VIX coming in as we get closer to the market. Futures up 20, Dow futures up 250. Kernot's VIX comes into 16.69. That's a really important statistic. We'll have to see how that unfolds through the trading day as well. Lisa Abramowicz and Tom Keene, John Ferro preparing for an opus at 9 a.m. And what we know for certain is every once in a while, every columnist writes a jewel. And one B. Ritholtz has done that for Bloomberg Opinion. Barry, I loved your column on the Great Reset. And you go to Robert Franken, one of the greatest essays of all time, over 20 years ago, led forward by Michael Mauboussin, which is the winner-takes-all technology economy. That's great. How do I do winner-take-all investing?
Well, one way to do it is to look at who the big winners have been and what the trend is like. And up until 2020, that was pretty obviously own everything passively and go with Vanguard and BlackRock. I can't tell, I don't think anyone can tell just yet, was 2020 a lockdown boredom aberration, or have we just flipped the script and suddenly we see the return of active investing and stock picking? I can't help but feel like last year was a one-off, that it's not a sustainable sort of thing. And the big tell for that is going to just be, look at Robinhood volume. Is that going to continue on its incredibly hot path, or is it going to plateau and reverse?
Well, within that, Barry, is a battle. I've had this conversation a couple times recently, and it goes back to, academics like Tusha Shande and others, which is sector or individual stock diversification, to use a phrase from the great Peter Lynch. I mean, when it's winner take all, do you do sector focus or stock focus?
So, all the academic data seems to suggest that a tiny, tiny handful of winners drives most of the market performance. And depending on the study you look at, it could be as low as 1%, it could be as high as 4%. But we know that the vast majority of stocks are essentially flat. A handful of small winners, a handful of small losers, and a couple of zeros, and they all sort of offset themselves. So there's only a handful of ways to make sure you own everything that's going to be in that 4% or 1%. You can give your money to the best stock pickers in the world, folks like Bill Miller. The problem with that is we don't know they're the best stock pickers in the world until after they've put up, decade-long track records. Or you can try and pick stocks yourself, and I think the average investor has had very mixed results with that. Or you could just own everything, and that seems to be the trend, at least in ETFs and mutual funds.
Okay.
In endowments, foundations, large funds, large investing pools, they seem to still be in the stock picking modality.
All right. Well, Barry, it's one thing to not pick stocks, but it's another thing to not pick a cycle and not pick the great reset that you've been talking about, how life has changed post-pandemic and what it means for investments. We've seen a lot of themes thrown out there of what may happen. What's sticking in terms of new trends that you can bank on in the post-pandemic reality?
Sure. So I went over 6 broad topics in the column yesterday. And, you know, my cheat is a lot of the things that everybody are all up in arms about and all excited about were really trends that predated the pandemic and that we were just accelerated. Hey, welcome to 2024. Essentially, we're 3 or 4 years ahead of where we were. So what trends are we seeing? Obviously, technology is just dominant, and it's not even a sector now. It's oxygen. If you are not tech-enabled and you are not taking full advantage of technology, you're going to be left behind. So it's not just the tech companies themselves. It's the companies that are deploying technology very effectively. So that's number one. Number two, look, my office has been virtual since we launched in 2013. We have clients and employees all over the country. So the idea that suddenly Zoom is a new thing or screen share is a new thing is really outdated. What last year did was reveal a proof of concept to large corporations who haven't gotten this message.
Okay.
And so while people like Jamie Dimon want everybody back in the office, I think you're still going to see a lot more flexibility, at least amongst white-collar workers, technology workers, more sophisticated companies that understand that to attract the best and brightest employees, especially the younger generation, they have to offer that sort of flexibility.
Barry Ritholtz, thank you so much for bringing me up with the younger generation. Mr. Ritholtz with an important essay there on winner-take-all theory in investing and in economics as well. Lisa, what do you see?
Well, I just was thinking about this idea of how cities have changed and whether the office really is going to come back. And frankly, you're not necessarily seeing the fear priced into markets. People are still thinking of building office towers. Macy's is thinking of building an office tower on top of their flagship store. And I'm wondering who's right. Are we going to see a return to offices in a massive way, or is this a new paradigm shift that we're not seeing accurately priced into markets? I find this fascinating.
You bring it up, and I make a joke about it, Lisa, but it's important. I think we've heard the word paradigm like 7 times this morning, which is 7 times too many. I'm not very big on paradigmatic shifts. I go back to what Barry said, is you go back to February before the pandemic. In some ways, we'll get back to that. In other ways, we won't get back to that. I think the uncertainties here, it's enough to keep you, me, and John in business.
Well, that's terrific. I personally find it interesting to think about the donut theory of cities, that basically the internal city center that used to be filled with offices is getting hollowed out. And this was a trend before the pandemic, and it's getting accelerated. And I think that that's interesting. In the markets, really oil is the main story today. The idea that that OPEC Plus is seeing a tightening labor market.
You mentioned the donut theory. The key news today is the Krispy Kreme IPO.
Have you ever even had Krispy Kreme?
Yes, I have. They have an emporium at Penn Station.
An emporium?
An emporium.
Okay, so you're going to be buying into the IPO?
I thought Ritika, for those of you on radio, Ritika Gupta just nailed the news flow on television. I mean, we call it VO, we pros.
You're still stuck on the pictures of donuts.
I didn't even read the notes for the guest after that.
I'm sure. The other interesting
Krispy Kreme report.
The other interesting story was the AMC share sale. The idea that it didn't even dent that.
There we go.
You don't care. You just want to look at
on radio. I'm sorry,
donuts.
Folks. It is visions.
He just wants
I mean,
to see sugar and dough, fried.
For those of you on radio, you
glazed
can envision le creme de crispe.
Oh, dear Lord.
We're talking French, Lisa, when the Montreal Canadiens
I heard that. That was great French.
The Toronto Maple Leafs.
Yeah, I can't. I don't see you at a Krispy Kreme.
Les habitants magnifiques.
No, oui.
Oui. Yeah,
Carry on. Look at those markets.
I don't know any more French.
All right.
That's it.
S&P
Show
futures.
is over. Au revoir. A bientôt.